Good evening, everybody. Thank you for being here for the emergency podcast. Before we get started, we are not financial advisors. Read the disclaimer. We have no idea what your situation is. This is for education and entertainment purposes only. We are doing a lot of research and basically giving our opinion. That is it. Please read the disclaimer, education and entertainment purposes. With that being said, tonight's episode is going to be a little bit different. Kris and I are not going to be going through a new company or something that we're interested in. We have major news out of Alphabet, and they may have redefined the entire AI build-out. So I'm going to go through the equity raise that they are doing, and then Kris and I are just going to have a discussion about it. So Alphabet just announced an $80 billion equity capital raise to fund its AI compute build-out. Now, this is where we are on this and what it actually means. The mechanics of the $80 billion number splits into four pieces. Roughly $30 billion comes from concurrent underwritten public offerings, $40 billion from an at-the-market program that won't start until Q3 26, $10 billion from a private placement to Berkshire, $30 billion underwritten chunk is split evenly, $15 billion in mandatory convertible preferred stock, and $15 billion in straight Class A and Class C common stock. Remember, Alphabet has two classes, GOOG and GOOGL.
What's the yield on the preferreds?
That I do not know. So the biggest piece, in my opinion, is the $40 billion at the market. So $30 billion of it is earmarked for an administrative charge in how it handles taxes on employee stock vesting, instead of withholding shares and using its own cash to cover the tax bill. It will issue new shares through the ATM to raise cash, mimicking a sell to cover model. That leaves roughly $50 billion for new growth capital. And the way that it's breaking down, $15 billion in common stock, $15 billion in mandatory convertibles, $10 billion from Berkshire, and about $10 billion from the proceeds from the ATM. All right. That is the broad strokes. We could go on and on.
Long Broadcom, long Marvell, long all the RAM names, long NVIDIA. I mean, this is simple. They're raising capital. They're spending more money on this AI CapEx build.
Yeah, so let's get into it. This is the largest or the second largest, I believe it's the largest cash flowing company in the stock market. I'm going to bring up their cash flow statement right now. This is what is very interesting about this, and it says a lot. And I'm with Kris. We're going to have a very crazy conversation tonight, everybody. This is a company that in 2025, is there a reason why I'm not able to move the slider over? Anyway, they did $132 billion of net income in 2025. They did $100 billion in net income in 2024. 160 TTM. Cash from operations, there's no shortage. They've been doing $100 billion plus since 2023. $101 billion, $125 billion, $164 billion in 2025. They just went from doing $91.5 billion in CapEx in 2025 to saying on the conference call they're going to do $190 billion this year, and they're going to spend even more next year. That was before this placement came out. So this placement is telling me they are throwing caution to the wind, and they are saying, you know what? We repurchase shares for what, the past decade? 45 billion last year, 62 billion the year before, 61, 59, 50. They've been repurchasing shares going back to 2016. So they basically are just reissuing shares they've repurchased. They are diluting, but they're diluting from stuff they've all bought back. Now, there's only one reason this company is doing this. They truly believe that they're going to make a windfall of profits from this build out in the future. So, Kris, I spoke for a little bit. What are your initial thoughts on this when you see something like this?
I'm inclined to agree. I think that buying back shares is a great way to get yield on your own cash. I mean, if you're sitting on there with 100, 200 billion dollars in cash, it's not really helping your business. So what do? You buy back your own shares. You could even keep them in treasuries. So I would think that their long-term vision on this cash is that the ROI that they're going to get is more than they would get buying back their own shares or probably doing the risk-free rate and putting it in treasury. So you're looking at about, and then you have Berkshire Hathaway getting involved, which means that Berkshire Hathaway is expecting at least 10 to maybe 15% a year in yield, if they were thinking about it from an earnings perspective. So I'd say Google is really putting a lot of money to work, but they're also got the cash flows to back it up. So yeah, I mean, yeah, I think the AI CapEx wave, a lot of people were scared, including myself, that it was going to end sometime this year and then next year we could see some pullbacks. But it seems like the demand is so strong that they're not even remotely concerned about it. They're like, look, we've got enough demand to justify the CapEx, so let's just do it. And so even if they're getting a low margin on the AI build out, initially you're always going to get low profit margins. But what happens is as you scale up, you end up being able to charge more, and then the cost incrementally becomes less over time. So yeah, I'd say Google is very, very bullish on the AI trade, and they're not cutting back, which leads me to believe that maybe some of the other guys are probably going to end up being in the same space. The only thing that worries me is that you've got the Anthropic, you've got SpaceX, and you've got OpenAI going to IPO sometime this year or maybe early next year. And if they do IPO, I mean, Anthropic just announced today that they're going to IPO. That leads me to believe that, number one, the equity portion of what Google had spent, now they're going to eventually realize it. So what they're going to be able to do is kind of sell some of it. And I think a lot of this at the money issuance might be a way for, I don't want to sound conspiratorial, but in a way, juice up the private markets when it comes to these IPOs. This way, when they sell, they can sell at like the highest amount possible. So like right now, if Google is spending this much, everyone is going to be assuming that the reason why is because AI is going to be much, much bigger. The ROI is going to be huge. So a lot more people get kind of leaned into the IPOs for Anthropic and OpenAI. And if they come out at about 2 trillion plus maybe, that means that the equity stakes that Google has actually become very, very juicy, in which case they could unload some of that and realize those profits and pay down this debt, or even eventually utilize the cash flows in the future to buy back shares again if they were to dip down in case there was a quote unquote a bubble. So yeah, it's just proper capital allocation standards. But like I said, I'm looking at this from the lens of someone who's like, I wonder what the onus on them is right now to do this. And the reason they didn't go into the debt markets is also very curious, because Google could access the debt markets for a decent price. So I'm not sure why they wanted to do share issuances.
Here's their balance sheet as of right now. They have $38 billion in cash, $88.78 billion in short-term investments. That is traditionally very short
Sure.
duration T-bills. So between the two that they have access to, $127 billion, tremendous amount of money. Then they have another $107 billion in long-term investments. And then they have, where's the long-term? $77.5 billion in long-term debt. So they realized that, in my opinion, they realized that they could, instead of tapping the debt markets and increasing their interest expenses, they could dilute shareholders a little bit and people would buy the stock. I think it's a great move for them because you know what? They get to issue shares, pad the balance sheet with more cash that they're obviously generating. They are not, in my opinion, increasing their CapEx rather than buying back shares when they have a decade-long track record of buying back a tremendous amount of stock, unless they truly believe this is the future. I think this is the last nail in the AI bear thesis. And the question that now comes is, what is Jassy doing? You have to believe Jassy's on the phone with Bezos tonight and was talking about, what are we doing? We're doing 200 billion of CapEx this year. What on earth do we do? They are in a prisoner's dilemma. And I mentioned it on a Mitch show that it's a three-legged approach now. You got Meta on one leg. They're not in the same game. They're fighting for GPUs, but for a different reason. Then you have Amazon and Microsoft that are playing the same game as Alphabet. And then you got Apple sitting there that is just not doing anything. And they're just buying back stocks. So I think that this really extended my view on the AI build out, and where it's going to come in two ways. I think initially the hardware plays, not just NVIDIA, Broadcom, AMD, but I think your Edens, your Vertivs, the hard assets for building the data centers, your Caterpillars, et cetera, will see a revenue inflow. But I think depending on how long it takes for the rest of the build out, we'll start to see that swing back into the hyperscalers, and their cash from operations will increase significantly. And I'll tell you, this just made me think this build out's 5 or 10 more years, not 2 or 3.
I know I'm going to get flamed for saying this, but I think in 2 years from now, when we look back, we'll see the stock at 366. I think it's going to be flat for 2 years. I mean, not necessarily like straight flat, but I think there's going to be maybe some upward move, but I think it's going to crash down and then it's going to come back up. And then eventually it'll get back to like 366. I think we're either about 10, 15% below the peak, or we're about maybe 30% above the bottom right now. Yeah. I think that the spend that they're doing is probably great long term. Short term, it's not good. I think it's going to actually compress them a lot. You're talking about a business going from a high margin, low capex business to now being a high capex, low margin business. And that requires a massive multiple re-rating. And that multiple re-rating is going to be detrimental to them. But it also means that they can keep up with the growth. So I don't know. I mean, their cash flows, future cash flows are getting tied to shareholder repurchases that are being done today, which is fine. But you're basically stealing from the future to stay relevant. So I would not be an owner of Google at these prices. I'd probably wait 2 years. I think at some point we'll probably see a pullback on this back to the 200s, maybe even 220s, 250s, and that'll probably be a better time to buy it than right now.
So I'm going to take the opposite approach on this one. I have no idea what the stock's going to do. Okay. I have no clue. I'm going to bring up a comparison of all the margins right now. Alphabet's margins are really good. I mean, And here's why I'm starting to think.
Don't believe. Your software is good, but it's hiding things, and I'm gonna call it out right now.
Gross
And it's
margin
not.
is correct.
No. Let me explain what
Okay.
this program is hiding that a real analyst would pick up, but the AI won't pick up. Their net margin includes a crap ton of appreciation because of SpaceX and their stake in Anthropic and their stake in other things. If it wasn't for those stakes, their net margin would actually be lower. Check it out. Check the
net margin on what?
So their net margin. So net margin right there. See your operating margin right there and your net margin, right? That net margin is being propped up by equity gains on the side hustle investments. Their actual margins actually deteriorating.
Only if they're recognized. So you look at the gross profit margin, operating margin, EBITDA margin. These are not things that can be distorted.
No, I'm telling you, don't look at this. Put this away for 2 seconds. Pull up your Seeking Alpha. Pull up the cash flows, the operating cash, right? Not the operating cash, but look at the income statement and look at it from there. So some people are looking at this and saying, this is actually undervalued because the PE is low. It's not low. Okay. It's actually getting worse because they're spending so much money. And
What do
over
you
time,
want me to look at on Seeking Alpha?
Okay. So go to the income statement for last
I'm there
quarter.
on the other screen.
Yeah. So pull it up, show everyone.
Okay. What line item would you like?
Okay. So go up, look at the so keep going up, right? So those are operating income is right there, right? So operating income last quarter went from 129, right? TTM to 129 to 138. So if you scroll down, right? Look at the income from equity gains. Hold on. Keep going. Damn it, where is it? Let me show you on my thing because
Kris, that's not recognized in net income.
No, hold on. Let me just share my screen.
What's up, Amit? Like net income margin is very simple. It's your profitability divided into revenue.
Right, but check this out. Hold on. Check it out. Let me put this back up. Share my screen. Okay, so this is their total revenue. Revenue is good. It's growing. Everyone's happy. Operating profits, growing. Everyone is happy. The challenge is right here. Where is it? Total non-operating income. Right there. Look at that total non-operating income. That's where you're getting that distortion from. So if you add these two together, it's like, oh my God, look, they're doing so much better. But the thing is, the reason why is because the bottom here is getting propped up. So almost $56 billion of this earnings, like not this, but their total earnings that's looking
Kris,
at their
non-operating income is 1.14 billion in the past 12 months.
How is it that?
It's like nothing.
How? But that's not the real. That's not the thing. Look at
and
it.
That's part of an income statement.
Where are you looking at the non-operating income on your side?
I'm looking at non-operating income on Seeking Alpha says 1.14 billion.
Then that's wrong. Their non-operating income right here is almost 56 billion from equity gains. And then if you go down, if you go everything together, then their net income attributed to shareholders looks like it's 1.6, right? But if you strip out this 56, is actually the other way. So now you're down to 104. I mean, you could look at the Google, what is it called? 13, what do you call it? Filing.
We can go to the filing if you want. The
the
reality is that they did 100 billion in 2024 net income, 132 billion in 2025, and in the TTM they're at 160.
But that's what I'm trying to tell you. The reason why, just ask Gemini. Go ahead if you want to ask Google's own AI. There you go.
So go to the cash flow statement, because we all know that net income can be distorted based on taxes and other things. Cash from operations is increasing every year. We're at 174 billion.
No, I'm not disagreeing with you. The capital, what do you call it? Cash from operations is not going up, but it's not going up to the same degree that the company is making it out to be, because so much of their quote unquote cash, right, is because you got this massive depreciation move over here. There's increase in depreciation, and the depreciation is going to keep going up. I mean, like I said, let's just ask Gemini. So what part of Google's net income was due to equity gains last 12 months?
Okay, after we resolve this issue, can we talk about the 80 billion capex?
Yeah, that's exactly what we're talking about. No, because the thing is, it's the same exact thing that's happening at some of these other guys, where the equity gains are sort of shielding the EPS number. And that's the thing that we have to be careful of, because when we look at these numbers, I'm like, oh my God, the PE is so low on Google. It's like, you know, and now their depreciation is climbing right here. During the period, Alphabet generated 160 billion net income, but 53 billion of that total was driven by pre-tax equity gains, primarily from unrealized paper gains from investments. So yes, their business overall, I'm not saying is deteriorating. It's, oh my God, it's going down in flames. But I'm saying be careful not to assume that this is a low PE multiple or a low multiple, only because you're seeing this net income that's being padded by 30% of their net income is padded by net equity gains. And by the way, those equity gains are one-time equity gains that eventually, once these companies IPO and they become free floating in the market, they're going to, like I said, if they go down, now your equity investments, non-operating equity investments don't really move up anymore. So your EPS next year is going to look like crap.
It's a fair point. It actually is a fair point. So I think let's use that to then segue into discussion, because I missed the first 20 minutes of what you guys were saying. So Kris, this 80 billion of dilution, do you think Google's doing it because they know? Well, actually, this flows seamlessly into what you're saying. Do you think they know their EPS is about to take a major hit because they can't account for this equity gain after the IPOs are done, and the stock's going to fall, right? And they think they're overvalued essentially. And so they're raising capital right now to get this 80 billion to fund the CapEx, because they have to keep the CapEx, which essentially makes you kind of bearish more than bullish, I guess.
Once I show this to you, you guys will understand. This is forward enterprise value to EBITDA for Google. It has never been this high for the last 10 years. Look. So yes, it's actually very smart of them to do the equity raise right here. Right? Their forward EV to EBITDA is almost 20 right now.
That's fair. No, it's a fair point. It's a very fair point.
So the key is...
But do you still think it's bullish on the CapEx story? Even if Google stock goes down, it's like, okay, whatever. They'll probably not care because, you know.
I think Google is playing... I think Google is smart in that they're trying to get as much capital as possible via equity issuances while their stock is overvalued. So I would say Berkshire Hathaway looks at this and they're not looking 1-2 years ahead. They're looking out 5, 6, 7, maybe even 10 years ahead. So the key here is Google is taking the right move for long-term shareholder value creation, but in the short term, they know that they're in a, how do I describe it? They're in a place where they need to take advantage of the capital markets, giving them an overly generous multiple, basically. And when the markets do eventually correct and things happen, they can do what they normally do. They cut back on their CapEx growth, right? I don't know when that's going to be. Maybe that's a year from now, 2 years from now, whatever. And they can go back into share repurchase mode, and they'll buy back those same exact shares that they're issuing right now at 350, probably at 200, maybe 250. Which means that they've generated 33% of return on their money that's just phantom money that they would have had to spend anyway. So all they're doing is just bringing the future back. The key here is would you be willing to pay a 20 forward EV to EBITDA on Google today, knowing that they are issuing a crap ton of equity in the future? I probably would not touch it. I probably say, let this thing come down, get back to a normal range that it's supposed to. I mean, if you just
it's 2% of the market cap. It's not a crap ton of equity.
No, it's not. But what it signals is that they are looking to make sure that they have enough cash and firepower in the future. I mean, they also took on $77 billion in debt too. So, right. I mean, I'm not saying that Google is like a dying business. Oh my God, short Google. Like, no one's saying that. All I'm saying is Google understands that the next couple of years are going to be subpar returns unless they figure out a way to raise that capital now, so that when the time comes when those subpar returns come and the stock is down 30, 40%, whatever, they can repurchase those shares at a very, very attractive price. So the CFO, right now, she's earning her money. She is out there earning her money right now. If my stock is overvalued, my first job is to basically do right by my shareholders long term, issue as much as I can, so that this way in the future I can buy those same shares back at at 30, 40% discount. And it's not to say that their EBITDA is not good. Its EBITDA is actually going to be increasing next year. So if you look at the EBITDA,
Chris, did you hear the biggest thing from this press release that has to do with taxes?
What?
Did you hear this? Oh, you guys didn't hear this
No.
yet. Okay. So this is the press release. Alphabet intends to use the net proceeds from the ATM program primarily to facilitate for a period of time an administrative change to how it meets tax obligations. The company expects approximately $30 billion of ATM program proceeds will be used to meet 2026 calendar year tax obligations. So 30 out of the 80 billion is to pay for their taxes this year.
I mean, they're going to have to recognize those equity gains eventually, right? And have to pay taxes on it.
Yeah, but the point is
coming from a super low base.
The point is that 30 billion is theoretically not for CapEx, is my point.
Yeah, it's 50.
Yeah, it's 50 for CapEx, which is still a crap ton of money. But it's more like, I've had a couple hours to think of it. I think it's bullish, but I think it's more so Google being like, dude, we're almost a $5 trillion company. Like, we're the second largest value company behind NVIDIA, and we don't have NVIDIA type of growth, and we don't have an NVIDIA type of monopoly. So we kind of need to be a bit creative here.
Well, look,
Yeah.
I'd rather them issue shares. And look, the reality is this is nothing new for Alphabet. In Q1 2025, they had maturities and sales of marketable securities of 20 billion. Q1 26, 38. But the long-term investments have expanded considerably. They always make money, and it's always part of EPS because they have such a big investment book. So to me, it's a nothing burger.
But Steve, the reason why is because this time around, their SpaceX, their Anthropic,
Yeah,
all
they
those,
get
they
re-rated
appreciate
higher.
significantly.
Absolutely.
If you look at the total enterprise value of this company, the last year has expanded by a significant amount from those equity gains. It's expanded equity gains from other sources, but this time it's different. I think if let's just say we go out 2 years ahead, we believe this analyst number of about $282 billion of EBITDA, right? I would say a fair multiple on this thing. I'm not trying to go extra stupid and be like, oh, it should be trading at like a single digit, but at least probably like, I would say 15 is conservative for them, right? So 15 times what? 282. And let's assume that they probably going to pay down 25 billion of the debt, right? So it's going to be what, 4.2 trillion minus, let's say 75. So you got an enterprise value of about 4.1 billion. Clearly, they're not going to be buying back any shares, right? So if they're not buying back any shares, and they're probably issuing shares, the current shares outstanding is roughly what, 12.111, right? So divide this by 12.1. Let's just say it stays flat even after the equity issuances that are about to do. $343. So I'd say next 2 years, you buy Google, you're probably going to waffle between, at the low end, maybe I'd say 250 if the bear market comes or shit happens, in which case they'll buy back a bunch of shares and this thing will get back to the 340s. by the end of 2027. So I'd say if you're buying Google today, good luck to you.
Bring up CapEx versus cash from ops in that, just those two. And look, Google's share price is immaterial. It doesn't matter.
So you want me to bring up cash from operations and CapEx?
But hold on, before you continue, Chris, do
Yeah.
you believe this is bullish for the infrastructure?
Yeah, absolutely. Absolutely.
Okay, so
I mean,
that's
Yeah, that's what I'm getting at, Amit.
that's the punchline, right?
Yeah.
Like,
yeah.
because if Microsoft tries doing this, or Amazon, which I don't think they would because Google has gone up so much and their stocks haven't, but I mean, it's going to be an easy way for Micron and Broadcom and Marvell to get more and more money coming into them.
Yeah,
So-
I mean, look at this. Their entire cash from operations in 2027 looks like it's going to go towards CapEx. If they do 230 billion in CapEx, they're going to be generating cash from operations of about 252. So that leaves them 23 billion in cash to do other things, which is probably goes towards interest payments. Interest and other.
Go back up. The biggest thing with this chart and why I wanted you to bring it up, as they increase the CapEx spend, their cash from operations is growing. At some point, the CapEx spend is going to stop, whether it's 2030 or 2028 or 2032, whatever it is. At some point, it goes into maintenance mode. But the cash from operations will continue expanding. They're not investing all this for that not to expand.
No, I 100% agree. I'm not
is
disagreeing with you.
This is likely not stopping anytime soon. The price of Alphabet or the valuation is immaterial at this point. This has such broader implications because we now have very clear visibility outside of their conference call where they said they're going to spend more next year. They were 91 billion 2025 CapEx. They're 190 billion this year expected. And on the conference call, they said they're going to spend a lot more next year. We just got this offering. These companies are in a prisoner's dilemma. They can't stop. And I think this just destroyed every AI bear with the narrative that CapEx is going to stop or go into maintenance mode or reverse. I don't think these companies can. And I think Jassy and Nadella have to respond at some point. They may not respond by dilution, but they're going to have to spend more.
They can't until the market forces them not to do it. If right now Google drops because let's say the market says, okay, look, the ROI on all the investments that you're not making is piss poor and the stock goes down by 200, I don't care what happens. The board of directors is going to turn around and say, stop this CapEx immediately and start buying back shares with the additional cash flow because the ROI that we're getting from all this CapEx is not working. As of right now, the CapEx picture is starting to generate ROI. It's very low margin. This is like Amazon back in 2010, where everyone was saying AWS.
What do you mean low margins? GCP is at 35% operating margins. What do you mean low margins?
That's because right now you're looking at most of that revenue coming in from the regular GCP operations. You're not layering on everything that's AI related. The AI part of the spend, if you took that and put everything into perspective as a total business, you would see that the AI portion that they're spending on, they're not generating nearly the amount of profit as they are on their just regular cloud business. Their AI cloud business actually is probably very thin in margin. The key here is over time, the AI portion of that spend is actually going to yield better margins over time. It's not just going to happen right then and there. Like right now, what you spent back in the day for just regular cloud infrastructure, the margins were high. Google was actually starting to make money in Google Cloud. Even when Google Cloud first came out, they weren't making money.
Yeah, I think that's a fair point. But now Google is framing this as relatively bullish because this was a quote from the press release. They said, AI is driving an expansionary moment for Alphabet. The company is experiencing strong demand for its AI solutions and services from enterprises and consumers at levels that are exceeding the company's available supply. Jensen last night said 100 billion for 1 gigawatt. If he's right about that, and Google is seeing more demand than supply, same thing I'm assuming the other guys are seeing as well. you would imagine the ROI will be pretty aggressive. Otherwise, they wouldn't be tapping the equity markets like. I mean, this is just, it's a full 180 from the past 10 years for them to be diluting versus buying back.
For them,
So it's like
this is
an
an
experiment, but this has to be a calculated experiment if Google, one of the best companies in the world, is thinking it's okay to dilute.
No. For them, they're thinking 5, 6, 7, even 10 years out, saying, look, we need to make sure that we have an AI franchise that absolutely dominates, because they do not want to be second best or even third best. Because what happens when you're second best and third best? You don't get the commanding margins that Google's had for the longest time. So they're doing everything that they can to make sure that they're in the right area for competition. Now, I will say Google is better positioned than, let's say, Microsoft is, because they own all of their hardware, right? They own their TPUs and they own their, so their margins for them should actually be better long-term than the other guys. So I think right now Google is in this, let's drive the investment as much as we can, regardless of how the market reacts to it. And you know what? We'll know how the market reacts to this in the next 2 years, because you'll see, like, this is the same exact thing that happened, if you guys remember, in 2021, where every one of the hyperscalers, oh, we've got so much demand, let's just hire everyone off the street. And then what happened in 2022? They all pulled back, right? Because then their share prices at that point had gone down. So it made more sense to lay people off and do share buybacks. You're not going to lay off GPUs. What you're going to do is just stop additional capex in the future. You're going to keep the revenue coming in, and you're going to get the depreciation, but the cash flows are going to stay strong. And then you're going to use that time to buy back your shares at a much lower price.
Tanner, how bullish is this for the AI movement?
I really like it. For me.
So let's. I'm sorry to interrupt. Let's just keep this very, very like separated. Is this bullish for Google versus bullish for AI? And what part of the AI? Because I am telling you, I'm very long right now on Broadcom, Nvidia, the memory players. Because if they're spending this much money, where's all that capital going? That's going into their coffers.
Yeah,
it's bullish both sides. I mean, look, Alphabet's the most vertically integrated company in the AI space. Nobody can argue that. They own the hardware, they own Gemini, they own the actual data centers, they own everything. They are spending aggressively because they see a huge ROI in the future on it. It's also very beneficial across the value chain, from chips and memory, Caterpillar, Vertiv, Eden, et cetera, et cetera. It's just bullish the entire AI trade. I mean, it's just a matter of when does this stop? And this announcement makes me believe that I'm not bullish enough, and we're going to see CapEx get pushed out quite some time. Tanner, you just got here. What are your thoughts on this?
Yeah, no, I agree. Google's taking the most market share from, like, out of the hyperscalers, growing at 63% last quarter. You know, they are obviously seeing what CoreWeave is seeing, what Nebius is seeing, that, you know, there's a ton more demand, not just for right now. They're not doing this for right now. They're doing this for years down the line, continuous new customers coming on board. I don't know, Chris. The thing why I typed in chat, where were you getting that there's going to be lower margin on, let's say, an AI factory versus, you know, traditional CPU data centers?
In the short term, you're paying a crazy margin to NVIDIA. You're paying a crazy margin to the memory makers. You're paying a crazy margin because you've got all of this CapEx, because the initial data centers that you have to do all the hardware, the facility itself, the power plants themselves, all of that stuff is expensive. So that's where I'm saying, like, if you compare the margins that you
get from token generation on the other side has gone way up. Like the cost that people are paying,
and the token, right, and the price of tokens is going down, right? So yes, you've got almost like the two contrasting things. You've got token production going higher, but you also got, at the same time, token prices collapsing on themselves. All right. So over time, I think AI cloud is going to be profitable to the degree that maybe regular cloud infrastructure is, but not right now. I mean, like I said, let's just ask Gemini. We can just ask its own AI what kind of margins that they're actually able to get from either side of the business.
I think that is one fair point by Kris, that it's a bear case we have to figure out. When these equity gain on investments are over after the IPOs, I mean, Google would have missed EPS badly without their SpaceX and Anthropic stuff, right? So I wonder if the management knows EPS is about to fall off a cliff in terms of the comps that they have, unless the other business grows so fast that it can make up for it, which 30% is really hard to make up for. And the stock's overvalued right here. Doesn't mean it's a bad company or anything. It's just time to dilute, right?
And Berkshire's fine with being part of that dilution?
It's not a question of if I'm fine or not being. I'm just wondering, like.
No, I'm saying Berkshire. Berkshire's buying an overbought stock?
Well, first, Berkshire already has a massive investment in them already. Number two, Berkshire is not thinking 1-2 years out like we're thinking right now. They're thinking, holy shit, this is probably a 5, 6, maybe even a 10-year time horizon, in which case they're probably looking at about 10, 15% growth. But Berkshire does not have any qualms about investing in something that's high priced, as long as they know in 5, 6 years they're going to get paid a crap ton more for it, right? So remember, their average price is $250. They got in at a lower price. So I think to some degree, Google is actually using Berkshire as a rubber stamp to say, look, we're doing this, and we've got Berkshire who's like this great long-term.
How did Sundar get Greg Abel to buy a theoretically overvalued stock at $350?
I don't know. Probably showed him some numbers, bro. Said, look, this is where we're going to be 5 years, 6 years from now. If anything, Greg Abel knows that a $10 billion investment now, this thing is going to keep up. The Anthropic and what is it called? Google open IPOs are going to come out. These guys are going to liquidate some of it. They're going to get some of that cash back, and eventually they'll turn this into a giant buyback machine in 2 years, 3 years from now, when the market is much lower.
Your two things seem contradictory.
Yes. Then what? Then why is it bearish Google then?
It's not bearish Google long term. It's bearish Google short term.
No, but why would Berkshire buy something short term that's going to collapse back to the 250?
Because that's exactly what Google and Sundar said. Look, if you give us this money now, we're able to kind of raise this additional capital that we can use as a firewall, so that in the future, when this thing does go down, one, Berkshire Hathaway will be able to actually increase his stake in the future, and they'll already have all this dry powder. If, let's say, Berkshire hadn't participated in this, right? Let's just say Berkshire is not the anchor buyer of these equities. They may not have gotten a lot of other people to throw their money at this thing. With Berkshire's stamp of approval in here, there's going to be a lot more people that say, yeah, give me some Google at $350 a share.
I don't think that Alphabet has a problem selling at $350 a share, and they certainly didn't need $10 billion.
$80 billion of share issuance. Trust me, you need a rubber stamp from someone at the higher up that's going to give you the credibility to do that.
I think Kris is right. Why the hell would they even put Berkshire in the press release if they didn't want a rubber stamp? I think he's right about that.
Hey, maybe. I just don't think that they needed $10 billion that badly.
It's not about. I think the $10 billion. Their name means more than the $10 billion.
I agree with that.
But look, there is a contradiction in what you're saying, Kris. But the second part of your argument does make sense. Like, technically, why would Greg Abel buy something overvalued just for it to dump, knowing that he could buy it when it dumps? But to your point, if he doesn't buy it, Google doesn't even have the chance to issue the equity, which is it's kind of like a coin flip. Like, if it goes below 350, Berkshire is happy to buy more. If it goes above it, Berkshire's happy because they got some gains. But it's
more about where it's going to be in 5 to 10 years from now for Berkshire. It's not about a 1 year thing.
Yeah, Berkshire's all about 5, 10, 15 years, man. They're not thinking 1-2 years ahead. And like I said, I think this is probably this is definitely some games being played by the CFO. Not to say that it's bad. It's long term. You want to create shareholder value, right? But dude, to be able to issue $80 billion of equities in this market with all these IPOs about to come out at a valuation right now that's at the highest point in the last 10 years, it's not a bad idea to do it.
I don't think it's just that. I think honestly they see such an advantageous or not an advantageous time, but just like they see such a pathway of continuous demand I think that this is a massive green flag to companies like CoreWeave, Nebius. I'll throw in IRN for the IRN bulls.
Can I ask you a question just from a CFO standpoint? Let's say you're a CFO. You have the ability right now to issue a crap ton of debt. They have what, 77 billion in debt. They've got crap ton more in EBITDA right now. So their net leverage is actually extremely low. Why didn't they just go to the debt markets?
Well, because they're at their highest valuation.
Right. So they think that they're overvalued. Otherwise, they would have just tapped the debt markets.
But now look to CoreWeave, who is tapping debt markets and not diluting nearly as much. Doing both really, but
no, but answer the Google question. Why would they issue shares and not
I
just
agree,
issue a bunch of cheap debt? If their
I
ROI,
said because they're potentially over. That's what I said.
so there you go.
I'm
You
not buying
confirmed
Google here. I'm
exactly
buying CoreWeave here.
Well,
Exactly.
it's also the whole Tesla model. Why issue debt when you have shareholders? They'll just buy the stock. You don't have to spend anything on interest expenses.
Wait,
There's
say
no
that
reason
again.
to.
Sorry.
Because it's
So there you-
dilutive.
In the long run, it doesn't matter. They'll just buy it back. That doesn't matter.
You could say in the long run they could pay off the principal and the debt.
They could pay off the principal on the debt right now with their cash. It's more advantageous for them because they make more in interest income than they pay in interest expenses. The reality is that by diluting, they're getting a free roll on shares they've already repurchased. And when the cash from operations expands from the CapEx expansion, they'll just buy all these shares back. It doesn't matter. This was
Exactly.
a smart move for Alphabet because they're not
Exactly.
paying any juice on the debt.
Yeah, this is not a bad move. I'm not saying this is a bad move for Google.
It's a
I don't
great
think
move
anyone's
for
saying
Google.
that.
And
No, it's
it's
a great
very
move for
bullish
Google
AI
long term.
movement. I mean, you look at the
I-
chip companies in memory, this is so bullish.
I think this puts a floor under Google's valuation long term because now they're able to basically get this free money, invest with free money. Why pay interest? Not to mention, remember, every dollar that you take out in debt, you have to take away from your enterprise value. So you take out 200 billion in debt, you got to take it out of your enterprise value somewhere. You know, like I said, otherwise they wouldn't be, they would just say, okay, screw it. Issue $100 billion in debt, keep the buyback program going. We're undervalued, baby. No, even they know they're overvalued right now.
Can we highlight Unflappable Frog's comment? Any of the hyperscalers interested in getting a loan through SoFi? Why can't they just go to SoFi? Get a loan.
The big business banking loan.
$80 billion loan with Noto? Like,
We're talking about AI companies right now. We're talking about data centers, and you bring this up right now.
Yeah, look, the reality is that take Q1 out of it, okay? From 2016 through 2025, Alphabet has repurchased $346 billion of shares. Think about that, $346 billion. This was their best move from a CFO standpoint because
Yeah.
And how many shares is it?
$5
The
trillion
80 billion?
company, they issue $80 billion. It's something that they will buy back in the future, and they get a free loan. And it does
Hopefully
not hurt
they-
shareholders.
Hopefully they buy back these shares at $200, $300, $200 a share. That'd be freaking nice, right?
Well, that
You
would
issue
be,
shares at
you know,
$350, you buy them back at $200. I'll
Yeah,
take
that would
that
be great.
all day.
That
Yeah.
would be great for them. Even if they don't, even if they buy them back a little bit higher, that's fine also because the cash from operations is going to expand. My idea on this is
oh, hold on. You guys are saying that'd be great for them. Shareholders would not be happy if the stock goes from 370 to 200. Like, people would be pretty freaking pissed off if that happens.
Yeah, but
Right.
they would be okay with it because then Google could buy back a bunch of those shares that they issued at $350 and generate real shareholder value. I mean, look, if I sell you something for $100 and I buy it back from you for $50, I just pocketed $50.
But I don't want to be the one buying it for 100.
So don't buy Google right now. That's what I'm saying.
Yeah,
well,
they're not going to be
let's
sitting on
talk
this
about
80
how
billion in
bullish
cash.
this is for the entire AI sector and the AI movement. I mean, this is obviously not stopping. And the other companies are in a prisoner's dilemma. They're going to have to do something. We had the keynote last night from Jensen, and Broadcom is obviously a winner in this with the TPUs with the Alphabet partnership. I mean, could we have gotten any more bullish news in the past 24 hours for this entire trade?
Well, so let's ask Chris, because Chris, your bear case has been CapEx slows down.
I take my bear case off the table for this year. This just forwarded my timetable about a year. Like, there's no way in hell I would try to short any of the AI not the hyperscalers, the hardware names this year. Why? Because these guys have still a lot more firepower to deploy in this, but next year might be a different question. Who knows? I mean, look, whenever I see this thing,
next year a different question.
Mm-hmm.
Yeah, I really don't like the models are only good. I was listening to Steve and Chris yesterday talk about the SaaS apocalypse. Even Amit's been tweeting about how the SaaS apocalypse is officially over. And it's like, how can you guys call this? Like, next year, the models will be so much better than what they are today. And the same fears that we had created this year will happen all over again.
No,
it's not the same.
Yeah, that's a whole different conversation. We'd have that conversation, but Chris, I want to ask you, why do you think this year we'll have another fear about CapEx? Like, if Tanner's right about the models getting better and Google having more demand, CapEx
should go up. Questioning that the models are not going to get better?
No, models will get better, but it's not going to replace your traditional SaaS business. If anything, it's going to enhance the traditional SaaS business. It's not going to replace it. I mean, unless the technology becomes so good where you can just say one shot, hey, listen, create sales and marketing teams out of thin air, create 10 years worth of trust, create SOC 2 compliance standards out of thin air. Like, you can't do any of that stuff. SaaS has a lot more regulation, has a lot more inbuilt staying power than you think. So right now, the initial push that SaaS was going to disappear, if someone, it's almost like someone's is going to say the same thing next year. Oh, look, the model got even better. What happened? The reason why I'm bullish on SaaS now is because Opus 4.8 came out, and what happened to SaaS companies?
They went up.
They all went up. They went up. If you had gone 60 days ago and Anthropic said, oh, we're releasing this new update, what happened to the SaaS names? They all got their asses handed to them. So just the fact that the market is now saying, okay, Opus 4.8, 5.7, whatever you want to release it, go ahead, release it. But at the same time, it's not going to destroy the economic moat of most of these SaaS businesses. Could it theoretically lower the future multiples? Probably, but no way is someone going to, Claude and saying create a service now or create a CRM.
I'm not worried.
Jensen also disagrees with you, bro. Jensen thinks
I get that, and I disagree with him.
You disagree with Jensen on this?
Yeah, because his thing was that, a robot that goes into a kitchen is not going to recreate a microwave. He's going to just use the tools that are around him. I'm like, yeah, that makes a lot of sense because he doesn't have the tools around it to recreate a microwave. It's right there and it's free to use. But software is not free to use. Having the seats that enable to use Salesforce, ServiceNow, all these things are extremely expensive. And code is extremely cheap for an agent to end up writing.
Tanner.
Sorry?
Now you're going to get Steve on your case. I'm going to go get some water.
Legitimately,
get him, Steve.
This is what Steve continues to do. The last 5 arguments, Steve's like, you did not just go there. And then he backtracks on everything that he said. You guys were wrong on Nebius. You were wrong on CoreWeave. You were wrong on Wix. You're going to be wrong on this too.
How am I wrong on Nebius?
You can't just continuously say you don't want to go there and then go, you know what, Tanner? He was right the whole time. And then he fucking defends me 4 weeks from now.
Tanner, I have a lower share price than you on Nebius.
Wait, hold on. Tanner, so do you think ServiceNow and Adobe, these guys are in trouble? That's like...
I don't think many of these companies will go away. I just think a lot of software companies, most companies are paying for 15% of the actual features that company is offering, but they're paying for 100%. So then all these companies can have different services. And I think that my biggest concern is as these models really improve, and I'm talking about really improve, people think vibe coding is going to get 15% better. I think the way that we've gone from ChatGPT 3 to ChatGPT 5.5 or potentially 5.6 is what's going to happen to vibe coding. You're going to have agents that are managing sub-agents that are coding perpetually 24/7. And software companies will be able...
So Tanner,
who's going to manage those agents?
It's
going to be the Palantirs of the world. It's going to be the ServiceNows of the world.
100%. 100%. There will be a lot of software companies to do very well. But like, does Atlassian need to do well, or are people going to go in and say, hey, can we debate our price rate here? And can we talk about how much we're actually paying? Because we're not using you guys nearly as much.
So Tanner, you have to look at it basically like what your last two sentences were. Software is a very large sector.
Yeah.
Not all software companies are created equally.
I
There's
know.
a very big difference between enterprise grade and single point. Single point is likely screwed. It really is, and over the next 2-3 years. But, and I believe this is where Kris is talking and Amit is talking, the enterprise level companies are likely fine. The reason is no compliance department, no general counsel, no CFO, and certainly no board is going to sign off on replacing an enterprise level platform that has proprietary healthcare identifying information with something that was vibe coded. Not to mention the contract.
You say vibe coded like it's a bad word. Vibe coded will be better than human coded.
Hold on. A company that has a couple of guys in IT creating proprietary software, no CFO or CEO is going to allow that to hold payroll information, to hold healthcare information. It's never going to happen. Now, when we talk about making things more efficient in the company and getting rid of something like a file maker or something like that, yeah, most likely, there's no question about it. But there are different levels to it. And you look at a true ERP system where you have all of your HR information, all your financial information, your payroll, your budgeting. You have to have SOC 2 reports. You have to have third-party assessments. There are so many criteria that the auditors look for. If you go on any of these compliance sites for Salesforce or for Workday, there are hundreds of certifications that they have to uphold that building this internally, you just can't do. So there's a very fine line between the two. But not to mention how contracts are structured. These contracts are 5 years and you can't get out of them. And the implementation of going into these large enterprise softwares.
Well, I think that is like 100% true. I don't think some guy from IT, from, a tiny IT department is going to dispute anything of what you said. But Microsoft paying these massive software bills could potentially say, hey, not only can we solve this problem internally, but we can actually bundle it with our own services and sell it externally.
Well, Microsoft already did that. They built Dynamics 365 to compete with SAP.
But what I'm saying is with these tools, they make essentially, you're making every individual engineer much more competitive. And eventually, it's not just like software companies can continue to exponentially make their products better and better and better. Some products are just solved, like payroll,
Can you share my screen?
You don't have
any guys having this debate? Sorry, let me just.
You don't have anything shared.
Sorry, guys. So I just asked Gemini the same question I asked you guys. If you want to keep debate. So,
No,
the CapEx. Yeah.
Okay, before we
for Google.
Yeah. Tanner, my question here on the software thing is like the fact that the market flipped, right? Some of these names are up literally 100%. I mean, Snowflake, Datadog.
They deserve it. Snowflake deserves it. I'm not.
So when we say SaaS apocalypse is over, why would you disagree with that?
I think that there's certain names, potentially Adobe even. There will be certain tools that disappear, that will not be needed. That will be completely vibe coded. And I'm not saying that it's payroll or something with extremely sensitive data. I'm not saying it's for, some of these observability tools. Like ClickHouse is only going to get stronger. Snowflake's only going to get stronger. A lot of these names are going to do very well. But I just don't agree with, IGV is now going to go up or something like this. Like there's definitely going to be individual software names that end up getting replaced or bundled away from larger companies like Microsoft that will take their massive swath of engineers and say, help us fix these internal tools, but then we'll also bundle it in, like they have done, as Steve said previously. But now they have a superpower to end up going out and doing this. And
yeah,
you gotta give me
I do agree with what Tanner is saying to a degree. I mean, look, Adobe's always been the one I've been worried about because I don't understand the moat behind what they have. I mean, you have Nitro, which is a knockoff Adobe Acrobat for PDF that works amazing. And from an editing standpoint, I've never really used it. I'm not an arts person, so I don't know how good creative is. But with AI, I would think that there's definitely some validity to that being at risk. I think that when we go down the rabbit hole, there are certain types of platforms that will not be at risk. But look, there are a good amount of software is going to have a hard time. Now, the bigger companies, they're going to utilize token budgets and the best engineers to fortify and make their products better. The question, at least with SaaS, is how far down the line does it go? I would think there's only a handful of companies that are impervious. The rest, anything's up for grabs.
I do agree with Jensen, though, as well, that there's going to be so much more demand for products and services that you're going to need more seats or agents as a service, right? Which is what we're kind of seeing in the earnings so far.
Agents as a service will probably take over the whatever loss in seat fees that we see.
Exactly. So here's an example.
What's the take rate for an agent using a tool versus a human?
Well, that's something that's still being determined right now, because this is such a new thing that we don't know yet. Like, I'll give you an example of something that ServiceNow is automating that used to take a human to do. Okay, so, and this is just a real world example of something that I've dealt with. Back in the day, you have multiple applications. If you didn't have an Active Directory, every application, when someone new came on, a new user came on, you would have to onboard them on every single application, and then every application they would have an individual username and a password. If they ever lost a password, then you'd have to log into that application and reset their password. After something called AD, right, Active Directory, now what happens is it's very similar, where you have an enterprise login, you log in, and that's your enterprise login, and every software has an AD feature in it now, so that when you get created an account, like a Windows user account, for that enterprise, automatically now you're able to log into all these other software products, okay? The challenge is people still lose those, right? And you still need access to certain software, and you also need to have permissions to access certain levels in that software. So if you want an administrative role versus just a read-only role versus an active user role, there's all these different roles. All of those things you would have to put a ticket in for. So you would put in a ticket and says, hey, my name is Steve Smith. I just signed on to this company. I need access to this specific application. The service person on the other side would be like, okay, let me see. Okay, who's your direct report? They would send an email to the direct, to your boss and say, what access level should I grant this person? Okay, he's in there's 300 different departments. Which departments does this guy belong in? Blah, blah, blah. And then you have to manage that user all throughout the thing. Now what you can do is just go to the agent, which is a chat bot, and say, hi, my name is Steve Smith. I need access to this thing. Okay, let me look it up. The manager sends an email to the manager, says, hey, this person's accessing, that needs access. Do you approve? Reply with a yes. You hit yes. Automatically now the agent provisions everything for that person, and you're good to go. No human interaction required other than the manager just clicking yes. That's it. That is worth a lot, because now you don't have a human doing all the bullshit back-end work. You have this one person doing access control.
I get it. They seem to have come out with it very quickly after these AI chatbots have come out.
No, but what I'm trying to say is, what is the value of what I just said to you?
High if you're replacing a human. What's the value of Microsoft to replace that system, or to try to replace ServiceNow? Like, all of these things are going to.
Microsoft uses ServiceNow. I'm just letting you know, Microsoft uses ServiceNow.
I know.
I mean, I'm just saying.
But imagine that. Yeah, imagine that they're paying these massive bills to their, tens of thousands of employees. It's like they are also going to try to look to reduce their own costs.
And but we also have to remember, Microsoft just got rid of their Claude Code licenses because of how expensive it was. Same thing with Uber. Uber didn't get rid of it, but they were complaining about it. So like, the idea that the tokens will replace a lot of the internal software in these companies when the tokens are costing more than the humans is another thing we have to watch out for. Like,
well, the tokens create the software. Like, the massive bump up in the cost price usually happens right at the beginning whenever the building is happening. Maintaining these systems is not going to be a lot of tokens.
Yeah, that's fair. So then the question is going to become, do the tokens become so unbelievably powerful that every application layer we have, like a Palantir or ServiceNow, they dissipate. I just find that hard to believe. Maybe
I'm
the
not saying
Adobe.
that.
No, but that is what you're implying when you say SaaS apocalypse is not over.
Yeah.
Right.
And Tanner, let me say another thing. You know, all of these AIs, they work on the premise that you have all of these massive amounts of data sets that they're able to be trained on. My organization, we have 15 years worth of tickets that we've had to address, right? That is a huge knowledge graph that actually builds in a giant moat. So if you tried to bring in an agent, like let's say like an Anthropic Claude agent, it wouldn't know how to solve the problem. With something that ServiceNow has, ServiceNow can layer that Claude agent on top of ServiceNow, go in, look at that data that's been existing for like the last 10, 15 years and say, hey, I need this. I'm having this trouble. The agent can actually look at all that data, see all the past resolutions, see all this stuff, and create an actual solution for you and apply that solution. And I'm sure Steven's seen the same thing when it came to Workday and Salesforce, because he's had to deal with it.
Yeah, I mean, I can tell you we replaced 7 systems with Workday. I'm not going to name what systems, but we replaced 7 with one. But look, no, the answer is that nobody can predict the future. We're going to have to see which way it goes. And there are things that you can do, and the things that you can do are probably just going to get better. And it's going to be a very interesting time in software. It's going to be much harder to replace enterprise than single point. And we have to see what happens. But let's get back to Alphabet and the AI revolution. What are we thinking here? Are we thinking that Microsoft and Amazon are going to
just go long in video? I don't even know what else to say, but other than just be long in video.
I mean, Chris, you were up last night. Did you watch the keynote?
I did. I thought it was interesting.
I mean, 80 to 120 billion for AI factories. Tanner, did I say that
100.
correct?
Can we watch the song at the end of the?
No.
What
there's a song?
No.
There's a song, and it was great. I saw Tanner and Jose reacting to it live, and I was like, "These guys want to dance, bro." I feel like we should all.
They were dancing?
They made like a K-pop song.
Tanner looked tired last night.
I was.
Yo,
tired.
what was your score today, Tanner?
Sorry?
What was your score today?
78.
That's still pretty good, even though you slept.
Actually, pretty well.
So, do we think Microsoft and Amazon are going to increase their spend next year the way Alphabet is?
Amazon, probably. Microsoft, I don't know.
And what do we think Zuck's thinking right now? Or what do we think Zuck's going to do?
Zuck is probably pissed off that his share price is fucking going down the toilet every day.
Can't
He's like, I get no respect.
The only reason Google can do this is because they're at all-time highs. Zuck's can't do this right now. There's no way.
Yeah,
Stock's
100%. 100% agree with Amit. 100%
But
agree.
Zuck isn't even playing in the same game because he's not competing with cloud services.
Yeah, it would be so
Yes.
weird if it was like we're raising 80 billion for what? To
Right.
make
So
that
that's
better?
why I kept the question with Microsoft and Amazon. I left Meta out of it.
Guys, I honestly think OpenAI and Mark Zuckerberg and all these, like many of the individual players that people thought were overspending are now, people are realizing that they were spending a normal amount. And now every other company is realizing that, oh, wow, we actually need to increase our budgets. We are going to be using artificial intelligence way more. And so they're having long conversations with Google, with AWS, with Azure, with many of the giant neo clouds. And so these companies continue to raise. Look at the backlog increases of all these businesses. It's off the charts. Like CoreWeave's backlog is like $100 billion, like what Google was a year ago.
Tanner, is this bullish for CoreWeave, Nebius, and Iren, do you think?
Of course.
Of course it is, because he owns them. Of course he's going to say yes.
No,
otherwise he wouldn't own them.
Tanner can be objective.
I think the biggest fear is honestly for names like Nebius could be one where, Microsoft and these sort of companies have given them tens of billions of dollars to help with their hyperscaler growth. Like they're essentially just paying them to set up data centers for them because they don't have enough power or like enough manpower to do so right now. But if they start to get really, really bold, raise tens of billions of dollars, they could potentially do it all themselves. I don't think anyone was needing many of these neoclouds. There'll probably be a handful of winners. The names that continue to come back as being like almost guaranteed wins, the same names pop up every single time. It's CoreWeave, Nebius, Nscale. I see those names constantly from customers, not from retail investors, from customers that are using some of these neoclouds.
Dude, is it crazy to buy CoreWeave and Nebius here at 50 billion and say, screw it, they're going to 100 billion?
CoreWeave is such a bigger business than Nebius. It's funny how much bigger they are, and they're the same price, if not slightly cheaper than Nebius. They have a much higher enterprise value because they've got a lot of debt, but they're just trying to tap any market that they can to raise more money.
But I thought Nebius also has like the software side of their business, which is not just pure, hey, let's just make what is it called? Cell compute. They actually have their own, they have their own platform. Like I when I see Nebius and when I've spoken to Sam about it, it's like they're trying to become an AWS. They're not trying to just be like a reseller of AI compute. You know, like that's not their core focus. Their core focus is we want a lasting business, right?
Yeah. So essentially, my understanding of it is that Nebius does run, virtual machines. They can essentially have multiple customers on single GPUs or single NVL72s, where CoreWeave runs it directly off the machines. They're not running virtual machines. So they essentially have to sell all the NVL72s for the most part to one customer. They don't do multi-tenancy, but they're dealing with the biggest customers in the world. So the way that I see it is, if you think that the AI beneficiaries are going to be 1,000 tiny companies that are paying very short-term deals, paying spot prices on GPUs, Nebius is the big winner. If you think that the real beneficiary is OpenAI, Anthropic, a handful of very, very large companies, CoreWeave is going to do very well because they actually also have a very good software thing. They're selling direct licenses for their software that's outside of CoreWeave, like not ran on their data centers. So they definitely do have a very strong advantage.
I'm going to say something and you guys are probably not going to like it, but I'll say it anyway. I think at one point after Anthropic and OpenAI, they IPO, at some point, they're probably going to be like 50% off of their IPO price. I think they're going to IPO at a very expensive multiple. And when I look at their business model, while it is very high growth, it seems like long-term, they can't necessarily sustain free cash flow to the degree that like some of these other legacy businesses have been able to do. And I'll tell you why. It's because right now what you're seeing is Claude comes out, they have the greatest model, they charge this premium price, everyone is happy, everyone is paying it, and then comes out OpenAI and they have a better model. And so people say, okay, well, maybe I'll switch to OpenAI because they're giving me a better rate and they're not limiting me nearly as much. And then some people are saying, well, you know what, I need to tailor my application so that the lower end features, I can offload that to something that's cheaper, right? A cheaper version. And I can do all the more complex things on this one. So there's this constant fight for the best that you have to constantly keep spending all of this money back and forth. And I think that's a challenge, because if there's one thing that I saw yesterday that should scare most people that were on the Anthropic and OpenAI side, it was that NVIDIA was trying to basically democratize intelligence, right? So if you saw the hardware and everything else on the personalized computers, they're trying to democratize majority of that functionality. So the question then becomes,
are you talking about Nemotron and running local models? Is that what you're talking about?
Yeah, that's what I'm saying, that those things will eventually compete with these big guys. Like right now, if you look at the cost per token that we were paying, or technically the business we were paying when ChatGPT 3 came out, it was like up here. It was crazy. And then ChatGPT, the next version came out and it was a lot less. And then now and everyone's switching to Anthropic and it was lower. And so it's this constant drive to basically make models cheaper, faster, and more efficient, where I think the business, the underlying business that is Claude and OpenAI, they're going to have trouble. And I think that's one of the reasons why they have been trying to broaden themselves out and trying to become more like, how do I say it? Like almost like consulting companies too, with private equity backing and everything else, so that they can create more of a legacy operating system model where like almost everyone uses it. But I think this is honestly the question that Alex Karp from Palantir, I cannot get his words out of my head. AI is going to be commoditized. There is a reason why Palantir is not spending $20 billion in training an AI model. They're like, why? We can plug and play any models anytime we want. Our goal should be to make the best application so that this way the customer can pick whatever model that they want, regardless of what it is. You want to hide.
But when the customer picks that model, there's an API that is processing those tokens, and it's either GPT, or Anthropic. That's why they're growing so much. That's the point.
For now, I think right now, all the businesses, they're focused on just that. But look, you've got Gemini, you've got all the DeepSeek models, you've got all these other companies that are distilling this stuff. You've got Llama 4 with Meta, you've got Muse Spark now with Meta also coming up with their own stuff. So I'm not saying that, like right now, we're looking at this and we're thinking, what is that thing called? OpenAI and Anthropic are Coke and Pepsi, and everyone else is just, whatever. They're like RC Cola. But these other guys are still around. And I think a lot of AIs in the future they're going to be tailored to whatever ends up fitting the customer the best.
But Chris, people drink Coke and Pepsi at the end of the day, right? More than anything else.
I agree with that. But I don't think it should be something where these companies should be valued like they're infallible, like they're automatically guaranteed the highest margins ever.
Anthropic and OpenAI's valuation is stupid. If they were in the public markets, they would not be at $1 trillion right now. And when they go public, and just like SpaceX, at $2 trillion is stupid. But I don't know if
I would buy Anthropic over SpaceX 100 times out of 100.
I agree.
Me too.
Anthropic is going to be one of the biggest companies in the world.
But it's still aggressive at $1 trillion, or you think that's cheap at $1 trillion?
No, I don't. I honestly don't think that it's aggressive. Like people called me crazy whenever I said I'd buy OpenAI at 250 billion, and everyone called Microsoft crazy at 50 billion. It's like,
yeah, but they're not 250 billion anymore.
You can say token prices are coming down. Like, yes, generally they are coming down, but the spend is exploding, and it's exploding towards the most expensive models.
So what price does Anthropic have to be for you to be like, I can't touch that IPO? What market cap in your head is like?
Oh, I don't know. I don't know the financials, but like.
But if you're ready to say $1 trillion is fine, there has to be some number off the top of your head that you're like, well, that's.
What I'm saying is I think a company that 10x's every year over year, with margins improving since January, gross margins went from 38% to 70% by April. Like they are profitable but growing extremely quickly.
No, but there's a number, Tanner, that it becomes stupid. Like, would you pay $8 trillion for Anthropic right now?
I mean, I need to see the multiple on the company. Like,
right.
I would definitely pay a big premium.
If you're not okay with $8 trillion, you don't know the multiple still at $1 trillion. So why is that reasonable to invest in?
No, I'm just saying, like you're saying it's egregious. I'm saying we don't know it's egregious. I'm not saying $1 trillion like that's an easy buy. I'm just saying like I definitely think that this company deserves a premium, like a company like Meta. Like, I actually think this is a company that's on par with the Mag 7 in terms of its importance right now.
Wait, hold on. Meta is not trading at a premium.
That's my point. That is Meta in the public market is getting destroyed.
Yeah. I'm just saying on par of like $1 trillion, $1.5 trillion, something like that. I think if it IPOs there, I wouldn't be surprised if they ended up showing numbers that like made me feel comfortable paying that and paying like a Tesla like premium for Anthropic.
The one thing I'll say, Tanner, is that there's a reason why people don't take Ferraris to the grocery store or Kroger. Okay. I think what it is there's this notion that the best model is the winner. And it's not the case at all. It's actually the most efficient. It's the most accurate and at a cost that people can afford. If you are serving up a model that no one can afford, guess what? People are not going to use you. And that's exactly why Uber
what are you talking, dude? What you're saying is not what's happening. The most expensive model in the world right now is Opus 4.8, and everyone's paying for it. It's the number one. Like Claude is the most used model.
Everyone is complaining about it,
and they keep paying. They can complain all they want. Ferrari's still going to sell cars
because it's new. Because people are trying it. Eventually, people are going to say, "Holy shit, my token budget just got destroyed in 90 freaking like right now." If you
also hold on to Chris's point, there's a reason Anthropic didn't raise the price on 4.8 versus 4.7.
Well, 4.7 was I think a lot of people had like, what do you call it? They were really disappointed in 4.7. They felt like they were being throttled on a lot of their usage because they didn't have the compute. But now they have Colossus 1. They're getting access to Colossus 2. They actually are getting access to compute. They are so compute constrained that they have to raise their prices because it's just an unbelievable amount of demand versus supply.
They didn't. That's my point. They kept it the same.
Yes, but it is rising over time.
No, but to Chris's point, if Anthropic's ever raising it by 10%, I don't know if everyone in the world is going to be like, all right, we're going to eat the cost. Like, that's his point. At some point,
they absolutely would eat the cost.
If ChatGPT was charging me $100 a month,
the gross margin
versus $20 a month.
The gross margin since January has gone from 38% to 70%. People are paying.
How do you know this? How do you know this?
It was in the semi-analysis report. I'll pull it up right now.
Because semi-analysis does not have official reports. Let's see what happens with the S1.
Okay, you find me a golden standard. They are the golden standard.
The golden standard is the S1. That's the golden standard.
Sure,
That's the company's actual report.
Sure.
We're not going to have to worry about. We'll know in about 2 weeks or 3 weeks when this thing publicly gets disclosed.
Right, but I'm talking about what's the data that people trust, that people are going on, that the entire industry is sourcing right now. It is semi-analysis. If you guys can quote a better source, I'll use that. But right now, it's semi-analysis.
If they IPO at $2 trillion, it's way easier to justify that versus SpaceX. But I do wonder. Okay, so investors just gave them $65 billion for 965. There's no way in hell they're IPOing at $1 trillion. It has to be 1.5 or more. So this is going to be a $2 trillion IPO.
I think it'll be somewhere between 1.6 and 2. I think that's.
So then we got to ask ourselves: is that reasonable for us as retail investors, or are we going to be exit liquidity? And I don't know the answer to that yet. But it's not.
Especially with Meta generating $100 billion plus of free cash flow, and they're still being valued at 1.6.
Well, Meta's doing over $100 billion of cash from ops and EBITDA. Free cash flows less because CapEx is up. But look, that's where I lean with Chris. Meta is I should probably look real quick, but for the past couple of weeks, Meta has been a smaller company than Tesla. Tesla does 1/10 of the profitability. So at what point do we start caring about actual profits? Now, I don't know that it matters for Anthropic and OpenAI. I think SpaceX is going to have a very big problem.
Yeah. Also, another crazy thing is the price that Anthropic is paying for Colossus 1 is something like 3 times or it's some crazy valuation versus other neoclouds, and I don't know why.
I mean, Charles brings up a good point. Think about how long these institutions and family offices have had private placements. I mean, you have to think that once that 6-month lockup, and I believe, is it SpaceX that has the different terms where people can get out in like a week? You have to think that they're going to take their positions and dump it.
Look, perfect example. And Tanner did a great job buying this dip, but Micron got to a 2x forward PE.
Crazy.
If Micron got to that type of level, do we not think Anthropic could drop by 50? When Dario says something stupid on an earnings call, once you get into the public, that's why Stripe being valued at $300 billion in all these venture funds. I'm like, this is stupid. All the fintechs are basically dead this year, and Stripe gets a $300 billion.
The only thing is, we have a little bit of history of that boom bust in the model or in the memory. I don't know if we have that history for the model maker. We don't really have any history.
Even with the boom bust, 2 times forward earnings for 600% growth, valuations can get really irrational, right? That could happen. Now that might be a great dip for Anthropic, but the idea that we wouldn't see, or for SpaceX, I mean, Meta fell to $88 in 2022.
I think one of the challenges that we might end up facing with Anthropic is right now we're judging Anthropic based on the lens of today, not necessarily that, hey, OpenAI could have a better model than them 6 months from now, or another model maker can have a better product than them a year from now. When we looked at the clear winner of the AI race 6 months ago, it was not Anthropic. It was OpenAI. OpenAI was the hottest thing on the planet. And then Anthropic came along. Now we can't just unilaterally say Anthropic is going to be the winner forever. I think this is still, we are early in the social media stage of everything where people still are using Friendster and using MySpace and all this other shit. And eventually Facebook came and just wrecked everyone and then became the dominant player. So I think we're still so early in it. I'm not going to sit here and declare Anthropic the clear winner and that they deserve the monopoly position. I think
that's a good point. And let me pose this. Why are we so quick to discount Alphabet? Why are we so quick to discount Gemini? We're
not discounting them. We're not discounting.
Oh yeah, but we're not talking about them. At the end of the day, Alphabet owns the entire system. I mean, they have something that Anthropic and OpenAI do not. They own their own data centers. They're running everything, and they have the distribution also with the hardware.
Yeah, so, both of those companies will own their own data centers, but
is it feasible that a Google One monthly membership solves the problems for everybody and they can potentially take on enterprise also? I don't know that OpenAI and Anthropic can't get disrupted by Gemini.
I think the reason why OpenAI and Gemini are not going to get a premium for their models is because they're tackling consumer, and consumer just doesn't have, like, the money's not in consumer. The money's in enterprise because they can pay. They have essentially unlimited budgets.
Well, Tanner, let me ask you this. How many people, hypothetically, do you think could pay globally for a chatbot $20 a month?
I don't know.
Hypothetically. Billion, 2 billion?
No.
Billion, bro.
Bro, $20 a month?
Yeah.
I would say less than maybe 300 million.
Yeah, I was thinking 300 million.
By the way, I think OpenAI has been leaning more into the enterprise nowadays, 100%. Especially but they're not, because they're going IPO. No, because they're trying to IPO. They want to make sure that they try to get as much enterprise layered on there as much as possible so that they don't look like, hey, listen, we're in low margin consumer. They want to be in high margin enterprise.
I know, but they're doing it unprofitably. The only one that's doing it profitably is Anthropic. Like, essentially, OpenAI is having to just give away tokens. They're resetting token limits. They're doing everything that they can to get these enterprise clients. And so that's why you're seeing the downloads explode, but no one's actually paying them for it.
OpenAI is a mess, bro. They're now going into robotics heavily. Like, they don't have a robotics plan. Like, get out of here.
Yeah, they're trying to be they're trying to be the everything play. They're trying to be consumer. They're trying to get into images and video. Like, they're trying to do it all. Where Anthropic is just trying to say, hey, let's figure out coding. Let's figure out the enterprise. Our images blow. Everything else blows. Let's do coding. And that focus is honestly the most profitable endeavor that they could do. If you want to share my screen, Steve, this was the article, just so then I don't leave Kris on read about where I'm getting this information from. Was the
Tanner, it's on red. Did you just say on read? It's on red. No one says on.
Yeah, sure. On red. Okay. Anyway.
Right here, this is a flood of demand driving by end users enjoying huge return on investment from consuming tokens. This demand growth is arguably only early in its innings. This year, Anthropic's ARR has exploded from 9 billion to 44 billion. Their gross margins on their inference infrastructure has increased from 38 to 70%. Gross. Okay. What about net?
Yeah, I know. I said gross margins.
Right, but so what about net? What's the net margin?
Yeah, they're not going to be a profitable.
Margin's negative, bro. They're not profitable.
Yeah, they're not going to be profitable, but I can almost guarantee you they'll be the fastest company to $10 billion in net income faster than any other company in the world. If there was a Guinness World Records for business, they are in that list for 100 different records. They are going to continue to smash it. And the same conversation that we had last time with Nebius and everyone disagreeing with me there. These companies are negative margins until they don't want to be. The second that they want to stop putting their foot on the gas, they're profitable businesses. The tokens are profitable. And
I'd say until their competition subsides and the competition stops spending money and accepts their defeat, I don't think that argument is going to be able to be made. I think at some point you're probably correct, but I'd say we're still early in this. This is not the end all be all just yet.
Also, they can't take their foot off the gas, Tanner, because their growth rate's going to slow down, and then that earnings multiple is going to compress pretty quickly. So I feel like that's. But then again, I don't think they can take their foot on the gas to focus on margins, because then the growth rate would compress.
Of course, that's why they want to be the monopoly, and they can raise enough capital. Like
yeah, but you're saying they can get profitable whenever. You're saying they can get profitable super quickly, and I'm like, I don't think they can. They need to keep growing.
No,
which is fine, but
they want to keep growing.
They have to keep. They can't justify $1 trillion or $2 trillion if they don't keep growing.
Brother, you're playing semantics with me. Of course, they're not going to be profitable right away. Of course, they're going to continue to focus on growth, not margin. But to say they're not profitable as a counterpoint to their valuation it's just not true, because they are growing. Like Nebius, CoreWeave, all of these companies, it's not because they haven't found a business model that doesn't work. They, like AWS, Google Cloud, Azure have proven that the model works. Now they need to essentially invest aggressively so then they can actually win market share.
No, I agree with that. My point is, when they become a public company, the public markets care about profitability. They're not going to be like on a net
in different sectors. They do in different markets. They do.
Well, sure. But my point is, if you're not profitable for a very long time, it's a little tough to catch a bid. I don't think Nebius or Nvidia or not Nvidia, Anthropic, I don't think they need to be profitable. I'm just saying the profitability switch, I don't know if it gets turned on in a couple of years. I think it might take a while for them to actually show GAAP net income, because they're in growth mode, and investors will subsidize that by paying the premium. But it's not going to happen overnight. This $10 billion of net income they're talking about.
Yeah. I'm just saying they mark it down on the calendar. They'll be the fastest company to 10 billion in net income ever in history.
Are you guys getting bullish on Robinhood or any of the platforms? I mean, I was having a discussion about this today with the Wolf people, and it's interesting. 24-hour markets are coming. Day trading rules are being suspended. Day trading rules are being suspended. What is that? Like the minimum required for trader, that rule is going away. What do you guys think about that?
Oh, Robinhood's the biggest beneficiary of this. There's no question.
24-hour. You just doubled up trading. I did just imagine. And someone said something. Said from 9 to 5, most people are working a day job. Imagine you come home and you're still able to buy Google dips and Anthropic rips and whatever. Like, dude, you just basically doubled the amount of transactions.
No, but that already exists. I think the big thing is the options that are becoming 24.
Yeah. No, it's options, 24-hour options.
Yeah. I mean, look, I think it'll be bullish. I wonder how much of an impact it's really going to have for the brokerages. Like,
you want to hear something? You want to hear something that seemed a little bit bearish, though? They said that people might blow up their accounts faster and might be turned off from that platform by doing this.
It's absolutely going to happen, 100%.
So it's almost like you want to kind of like have these customers, but you want to bleed them slow. You don't want them to burn through their life savings, betting on meme coins, and then now they have to like suffer for another 5 years to get enough money together so that they can put money back into Robinhood again. You
know what's funny? I always have these conversations, and then people are like, "Oh no, I don't invest. I tried that. I got hurt. It's a scam. This is a fixed game. Yada yada yada." You guys probably hear it all the time, and it's like every single time that there's these cycles, it just completely kicks people out of the markets. To never return. They never get back in. I'm always surprised that there's even more people around to invest once again. Like there's always new people entering the markets. It feels like retail continues to grow, but yet I constantly hear these stories about people blowing up their accounts.
It's human nature. It's human nature, man. At the end of the day, we're all a bunch of degenerate gamblers at heart. I mean, we could just take our money, put it into savings and treasury, but who wants that? Everyone gets addicted to that dopamine hit, man. And now can any one of you, look, all 4 of us have made it. Okay. If we took our money, just put that shit into treasuries, we wouldn't be like living the private jet setting life, but we would, we'd be okay. Are any of us going to quit the markets?
I don't know what you're talking about.
Those ServiceNow calls got Kris talking different, baby. Kris woke up and was like, I made it. I don't know if you guys made it, but I fucking made it.
I mean,
I didn't even try to make it like that, but I'm trying to say that human nature is one of those things where even after you've made it to a certain level, you're going to say, you know what? I need to go to that next level. And then you get to that level and it's like, I need to go to that next level. There's this constant thirst for that next level that you just cannot get out of a person. And that's the thing, whether you're at $10 or you're at $100 or at $1 million, people are like, I need to fucking double this.
But that's also because we care about the market. So let's say your net worth goes from 100,000 to $1 million to 5 million. You're going to want to get to the way you got to 5 million was by picking stocks. So you're going to try to get to 10 or 20 by picking stocks.
No,
right?
but that's the thing. The people are addicted to that feeling of winning. Like, that's the thing. Like, I know people right now, you go to Vegas, right? Some of these people are up 5 million and they can't get out of the casino. They just will not leave. So it's kind of the same thing with the stock market. That's what you just said, Tanner. These people, they blow up their accounts and then 5 years, not 5 years, like 6 months later, they're like, shit, I'm back again. Like, I know plenty of nurses at my job. They lost a ton of money in 2021. You know what they were doing in 2022? Doing overtime so they could throw money into the market again. And they learned nothing from 2021. They were still buying the same shit goes.
Well, if they were getting in at 2022, I hope they bought the bottom.
No, because they were still buying the shit go company.
Yeah. You revenge trade at that point,
yeah,
right?
but Kris, let me ask you this. At what point do you start thinking about cost of capital and opportunity cost? Because if you're just going to plow capital into treasuries at a 10-year rate at 4.5 or 4.6, you have to think that unless you get a lost decade like we saw in the 2000s, which there's no indication of, inflation's going to eat away at that capital, and you are going to get absolutely crushed.
You're thinking too logically. I'm talking about human nature rather than like actual logic. Like, logic is one of those things. Check that shit out the door, bro. This is the capital markets, baby. This is the casino. All right.
This is right.
Ain't no one leaving the casino.
Hold on.
Ain't no one leaving.
Is an S&P 500 fund a casino?
That's the only thing that's not a casino.
Chris's point is we're picking individual stocks when we should be 100% in an index fund and call
I'm
it a
50% in an S&P fund.
Yeah, that other 50% is gambling essentially with stocks.
Right, but I'm backstopped by the S&P.
I'm not gonna lie. My 401k is in the index fund only because they won't let me use it and day trade with it, baby.
Hey, Kris, you want to know something? In October, I get full access to it.
Congratulations, dude. Let's go.
Steve,
Are you going to play around with it?
I'm do this.
Steve, you need to pick one stock to YOLO your entire 401k into.
Hell no.
Yeah.
Trust me, I got a call from the shadow government on Friday.
I'm gonna tell you.
The shadow government told me a stock that needs to be bought, and maybe that's the stock you buy, Steve.
So
the shadow government.
I had a thought in my mind that maybe when I move it to somewhere else, maybe SPY is not the ticker it goes into.
It's PLTR.
It is not PLTR.
QQQM.
I will tell you guys. I mean, listen, I was thinking about Amazon, but
wait, is it your IR? So your 401 is you're gonna see. By the way, a lot of my gains have actually been in my IRA. So what happened is, as I left my job, I was able to convert my 403b into a traditional IRA, and then I was able to trade individual names using my traditional IRA. So just letting you know. So I'm guessing that's what you're going to do, right, Steve?
I still have to figure out what I'm going to do. I am being forced to. So I have to, since I left the company, I have 30 days after the company match gets deposited, and it gets deposited in October. So I'm going to have 30 days after that to figure out if I want to stay with the same company. And if I do, I have to put it into a different type of an account, or I can roll it out into somewhere else. So I got to figure out exactly what I'm going to do.
Yeah, bro, I hate it. That's one of the parts about putting money into retirement that I hated. You'd look and it's just be like BlackRock this and T. Rowe Price this, and you look at the total returns. It was like stupid companies were
Well,
trading
I'll tell
10%
you
a year.
It's
It's like,
funny.
I can't live off of 10% a year compounded. I need that 50x gain, baby. What the fuck? You know, give me that money in cash. I'm not gonna lie. There was one time where I almost left my job. I was like, bro, I need to buy the dip. Maybe I'll quit my job so I could take my 401 money, put that shit into a traditional, and I'll find another job some other time. You know,
Dude, I love late night Monday mojito, Chris.
Oh, it's great.
I
It
knew
is
he was doing
great.
well whenever I saw the mojitos on Saturday. I saw the mojitos on Sunday, and now it's Monday. He's got another mojito.
Dude, service me
You're
up.
not alcoholic.
Balls are hidden, baby.
Oh, no? Okay.
But I did want to. I while we were talking, I had Claude rip through Alphabet's Q1 because I couldn't find my sheet. The numbers are actually pretty crazy. GCP grew, as you guys said, 63%, but 462 billion backlog for GCP.
And what do you think it's going to be next quarter?
Oh, it's going to be huge. So listen to this. Enterprise AI solutions became cloud's primary growth driver for the first time. Products built on Gen AI models grew 800% year over year. New customer acquisitions doubled. $100 million to $1 billion deals doubled year on year. Multiple $1 billion deals signed. Existing customers outpaced initial commitments by 45%. And then Gemini-powered workflows grew 30x year over year. Like, these are crazy numbers out of here.
You're not a real degenerate unless you start borrowing from your 401k and invest with that. That's when you're a real degenerate. Call up my fund. I was like, yo, let me get the max. 50K. All right, make it happen. Let's go. I need to buy the dip.
Out of control.
I
Do not
the
do
way,
that.
I convinced my wife too. I was like, listen, babe, the interest, it just gets paid back to me anyway. You know, it's okay. She was like,
So Tanner, the reason why I asked the question to you is because Google's paid subscriptions reached 350 million between YouTube and Google One.
Yeah.
So that's why I asked, how big do you think the TAM is on the subscription model?
Yeah, well, I just don't know how many people out there are spending for a chatbot. You know, there's free use ones. Google One's extremely useful. YouTube Premium might be the greatest subscription of all time. I don't know if there's going to be 1 billion people ready to pay for Gemini AI Pro. I don't know.
Shit, bro.
The first party models, 16 billion tokens per minute via direct API use. How wild is that?
That's not that wild. These numbers, like all these, like even Qualcomm today, like all these companies are having quadrillions of tokens processed. It's kind of normal now. It's not really impressive when I see those numbers. What's more impressive
metric.
Yeah, it's just another metric. Like, of course they have. I would imagine we process millions of tokens a day ourselves. At least I think I do with ChatGPT.
Imagine if Google, like early days, was saying how many websites were clicked, how many blue links were clicked. It's like, all right.
we did a
I do think though, when the news came out that they're ready to issue 80 billion, it was, we've just never seen a large cap do this at these levels. I mean, Apple made a whole career, at least the past 10 years, to 5 trillion market cap off buying back shares, you know? So
where's Apple going? That's a good question.
That is a good question. NVIDIA would never do this, but it would be kind of crazy if NVIDIA even thought of diluting.
Apple is just chilling on the sideline saying, look, we don't need to compete. We're fine. Like we've got the distribution. We're gonna stay out of this. And I think the market's actually giving them a premium because they're not spending a giant wave in CapEx. Look at Apple's stock. It's just been nice up and to the right. It's not like your crazy move higher, but they're like, listen, we know what we do. We do the best thing, the thing that we can. We own the distribution. Let them fight it out. And whoever the winner is, we'll integrate their model into our OS and call it a day.
So are we buying Micron?
Build a bear, bro. Build a bear is where we need to be, guys.
No.
I'm telling you, we're
Dude,
we're
Micron's going to
sleeping on
1500. We know it's going to 1500, right?
Yeah,
We're all
probably.
sleeping on Build a Bear, bro. Build a Bear is where it's at. I heard
What is-
Nvidia is gonna
Is that your biggest buy right now? Is that like what you're focused on
Build a
purchasing?
Bear.
No,
that's a
built
joke.
every man.
That's a joke, man.
Yeah,
Relax there, man. I'm not trying to say like Build a Bear is the growth company all of a sudden. I'm just saying,
Dude, I'm not going to say what stocks you've been pitching, but like honestly, it's not far off from Build-A-Bear. Like you're just picking names out of a hat, and being like, "Let's
I made a
go
pretty
on
good
this
case.
one."
Hey, listen, I pitched Zoom. It did really well for a lot of people.
Zoom
okay?
is up quite a bit.
I know, and
Because they're
if
Anthropic.
Build-A-Bear was up quite a bit, I would have been like, "Chris did his DD." Like I don't know.
Build a Bear's coming. Don't worry. You'll see.
What is the names that you guys are focused on right now, or the name?
My main one that I've been focused on is just ServiceNow. Like dude, my DD on ServiceNow is like literally last 30 days. I was trying to just test everything. I called up as many friends as I can who have like ServiceNow at their organizations. I'm like, hey, like what's going on? Have you spoken to anyone about switching away? He's like, what are you, nuts? Like, no, we're gonna be on this thing forever. I spoke to some of the senior leadership that I have like connections to. They said like, nah, we're fine. Like, we're going to wait a little bit more until we adopt their AI features because we don't know how effective it would be. Plus, you need like a budget for it. You can't just say, oh, great, they have AI projects. Let me give the company credit card and, start. No, you have to go through contracts, RFPs, and you have to have like onboarding and training. And then, so the one thing I can tell you though, is that my organization, we just recently switched to Google Workspaces. And I know that sounds kind of crazy, but we are a heavy Microsoft only place for a long time. And we've actually been switching to a lot of Google Workspaces. So as much as
you
people
hear that,
wanna...
Steve?
No, I mean, it's true. Google, I'm sure that Steven knows about that too, that a lot of businesses have been using Google Workspaces, like, with Sheets and Office.
Switching away from Microsoft to the Google Workspace.
Yeah, I would say I don't know anymore because I'm not in corporate America. But when I was there a month ago, not a single thing ever came to me in Google Sheets, or I'm talking from outside people. And I would say 80% of the time I would get Teams links for meetings, 18% of the time Zoom, and maybe 2% WebEx or Google. WebEx, Google Meet was never sent to me by anybody.
Chris,
Yeah.
why is Microsoft not the easiest buy right now?
I don't think it's not a buy. I don't think it's the greatest buy ever. I think if you're looking for a Mag 7 name, Meta and Microsoft seem the most appealing to me, but I don't know.
I mean, if they start actually selling chips, like legit.
I have all of them, by the way. I've got Google, I've got Amazon, I've got Microsoft, I've got Meta. I did buy a little bit more of Microsoft recently, but the rest I'm just like, let them do their thing.
What about you, Amit? What are you buying?
What did I recently buy? Reddit and Shopify. Tanner mentioned the other day our portfolios are converging a little bit, but you haven't really bought. You're still on the fence on Palantir.
Yes, yeah. I heard you tell people that I was buying it. I was like, no, I haven't bought it yet, but
You bought like one share, I think.
yeah, just to put it in the watch list.
Yeah, I think the SaaS apocalypse thing is I don't know, dude. I think SaaS summer's on the way. Like, I agree with you, Tanner. The models will still get better, but the fact that these names are up as much as they're up, I think the market just woke up and was like, we were being stupid the whole time. Just like the market was being stupid around Micron at 400. And if they go back down, if Zeta goes back down to 18, that's a buy. If ServiceNow goes back to 80, that's a buy. Just like if Micron were to go back to this point 700, that's a buy, right?
There's one SaaS name that I haven't seen a lot of people speak about, but I bought today actually. It's HubSpot. Have you guys ever looked into HubSpot?
It's up a ton today.
Yeah, it's up a ton. I got in like midway through the day, so I'm up on the position, but I bought some HubSpot today. Yeah, it's interesting. Like, just to see the crazy sell-off on some of these things. I mean, you look at HubSpot, they're doing about 700 billion in free cash flow right now. They're buying back all their shares at this point. It's trading at like 70% off what it was in January. So I'm like, look, even if it's just a dead cat bounce, it's a pretty healthy dead cat bounce to like, at least 300, 400. So I think a lot of SaaS names got oversold. And I think the reflex is probably going to do the same thing. And you're going to bring this thing back to like, I don't know how far back up, maybe 50% higher from the lows. So
I think even Mark Benioff was talking or saying a bunch of good things about HubSpot and how oversold it was recently on the All In podcast.
Yeah.
He was saying that name was oversold. Like direct competitor.
All right, Tanner, do me a favor. Because I obviously think you're nuts for this.
Yeah.
I want to see Kris and Amit's reaction. What's your bull case for Wix?
For Wix. Wait, before Tanner said that, who the hell's buying CrowdStrike at 770? Like what?
I don't know, but it's helping me in the stock draft.
That one is the most confusing name to me, right? I mean, like I get cybersecurity matters, but
look, it's the top dog in cybersecurity, and it's just pulling down future obligations.
It's more expensive than Palantir now, bro.
Oh, I'm not saying the valuation makes sense. I'm just saying that they're expected to have tremendous growth because of how hardened attacks are going to be from AI. So,
yeah, I don't actually think it's an explosion in growth that people expect from CrowdStrike. It's just the durability.
Yeah.
Like, I think people expect that this company is going to continue to grow and collect a premium for 20, 30 years. Like, cybersecurity is the definition of non-discretionary.
Yeah.
In a depression, people will pay their bills.
I can tell you firsthand that it is the one thing you do not want to deal with when you're running an organization, because the cybersecurity audits you have to go through are crazy. And when you start looking at what cyber insurance is, you really realize real quick how hardened you have to be. And you layer on, Kris probably knows everything that his company is doing. We had so many different products. It's just crazy. And the attacks don't stop, because when you're a big organization, you have so much target-rich data that the attacks just keep coming.
If you guys want to look at a really major case, look at type in Change Healthcare.
Oh my God, that affected us.
That impacted the entire country. Like that is the level of attack. And the thing is, like, the attack vector is small, but the impact is large. So if you think about a lot of these companies, I mean, a lot of these hackers, they put up ransomware and they're getting paid, by the way. A lot of people, they're just paying it. So the cost of cybersecurity is like you said, Tanner, it's non-negotiable. Even in a depression, you're going to need cybersecurity. So look at what Google paid for Wix. Insane price, but it is what it is.
For Wiz.
Wiz.
Yeah. Sorry,
32 billion.
Yeah.
So, Tanner, Wix, what's the bull case?
Yeah. By the way, it's up like 20% since I told you.
Okay, because they're cutting labor.
Yeah. It really, they own one of the fastest growing harnesses, which Jensen just told at the GTC Taipei that, like, there's two main things. There's the model and the harness that makes the agent. And Base 44 is one of the fastest growing AI tools out of the Cursor, Lovable, Replit, Bolt. Base 44 is growing insanely quickly. And they don't need to dilute in order to grow at this rate, because Wix is the backstop. They are funding all of that growth. And Wix itself, like Wix.com side of the business, is not decreasing. They're growing. Free cash flow positive. It's
only a $2 billion market cap. I mean, that's
and they do $2 billion in revenue a year.
Oh wow,
it's 1 times price to sales.
That's and not for what's their gross margins like? Let's take a look. So first thing is, let's just say EBIT.
I think it's 65%, but it's coming down because Base 44 is growing so fast. It's got worse margins.
Okay, I mean they're generating about Look at it. They're generating 500 million in cash, operating cash. What's the issue? That's actually good.
Tanner, do you own this or no?
No. I pitched,
you don't.
I pitched things to Steve and I said, this is a really interesting name. And he just laughed in my face. I'm like, now he's silent because.
No, I still think it's a good company.
Exactly. Hold on. This is actually not bad. I don't know. Can you share my screen, Steve?
Yes.
Well, but hold on. Tanner, why haven't you bought it?
He's going to show you the exact same fiscal AI screen that I just showed.
Yeah,
you.
Tanner tried running me through it the other day. I can't get past the whole website part.
No, but why not buy it then if it's this compelling?
Because I like CoreWeave and Nebius better. I like companies that double year over year.
But look at this thing. It's generating free cash flow. 500. Dude, it generates 500 million in cash flow. It's worth 2 billion. That doesn't take a genius to figure out. This is not a bad company to invest
but
in.
is it sustainable when AI comes for it? Like it's Wix.com.
I think that's Silver's point, though. Base 44 is using AI, right?
I mean, unless they had some kind of significant windfalls for this free cash flow and their numbers are going to go down. Like, it doesn't look like the free cash flow is going to slow down anytime based on analyst estimates. So what's the issue here?
Tanner, the reason I asked if you own it is not if you like other stocks better, but is there a level of fear you have underlying the company could get hit pretty hard by like a Claude vibe coded website builder?
No, I mean, there's definitely those types of concerns. I'm not seeing them. I find that every time that I try to find these companies that are undervalued, I don't do well. Like PayPal being another example. I'm like, I found this company that clearly is doing better numbers than what the market's pricing them for. I just find I underperform. So I'm sticking to just like statistically what I do well in, and what I do well in is just disruptive growth. I've done well picking Micron, Nvidia.
I don't think you're wrong on this one, Tanner. I think you're actually got something real here. I mean, look at the forward enterprise value 6 times. Their free cash flow looks like it's projected to do the same exact thing, even if it does stable free cash flow, does not grow at all, and just utilizes majority of their free cash flow to just buy back shares. You're talking about buying back the entire company back in 4 years. Yeah. And you get the rest of it for free. You're basically getting the giant equity stuff for free. Do they have like a lot of debt or something? Like, what am I missing?
Dude, I'm telling you, it's really, really interesting. But the problem is that people are essentially pricing Wix at nothing. But even if you do price Wix at $0,
and they get $2 billion in cash.
Yeah, and they're buying back 40% of their float or 40% of their outstanding shares.
Tomorrow morning, if you look at the options market, Chris Patel will have 100% of the existing, what is it, $100 strikes for January.
Oh, I should not have put Chris down this rabbit hole.
No, I'm trying to look for a bear case right now, but I don't see
it. Just salivating at borrowing against his 401k to buy spreads on.
Listen, their bear case
Claude can do what Wix does.
Their bear case is that at the end of the day, the main business is a website builder, and that is easily being disrupted.
Guys, I've built like 4 websites in the past month by telling Claude to just build this shit. And then I go to, I think it's Netlify to host it. It's $9 a month.
Cloudflare is 10.
Yeah, I mean, that's why I kind of struggle with this thesis. But the numbers wise, Chris is right. It's cheap.
The numbers are good. It's the thesis about if anything's getting coded away, this is one of the first things.
Okay, so
the thing is that it all comes to total cost of ownership as well. So in the cost of a Wix subscription, you're getting that hosting, you're getting that so Wix is developing their own models that are running at essentially a 95% decrease in token production because it's just focused on website building. So it's not any of the
hold on. Tanner, what did you say? You don't have to use Claude for everything? Go ahead. Can you repeat that? Because it's cheaper to do it via Wix? Huh? Yes. I thought we were all supposed to get the 4.8 subscription to create websites all of a sudden. Sorry,
I don't know the future. So it might, Claude might be used for everything, but essentially users are still going up. If you keep going down, average revenue per user is climbing up. Cohorts are sticking around. They have a net dollar retention of 105%. There's no signs of death here.
Listen, if it was,
but there was no signs of PayPal's death until they started to decline.
Yeah, but
guys, I gotta get out of here. But It's a fun time. Appreciate
mean,
everyone. Thanks everyone.
Later,
for being here.
Matt.
Looks like majority of their money is coming in from subscription. Business solutions. So that's not bad. I mean, they're slowing down, but it's not not growing.
Dude, no, growth is accelerating. They're like the highest.
I would
they're at
say
the
to
highest
you,
rate of growth that they've seen since like 2022.
I would say to you, Tanner, this is a really good example of an asymmetric upside with a very limited downside for two reasons. One, they're definitely not going bankrupt because they've got a ton of money in cash. Half their market cap is cash, right? So if there is any sort of tailwind for them that, hey, our growth rate hasn't slowed down for another year, then the AI disruption narrative goes away and this thing jumps probably like double from here.
Just so you're aware, Chris, because you're pitching to me like I turned this name down. I'm the one who pitched Steve on this name, and I thought it was
I don't see a bear case. So maybe Steve can, if Steve, you rejected it, what's the bear case here? Other than just the narrative is that they're going to die from Claude coming in and saying, create me a beautiful website and I don't need Wix anymore.
Yeah, my bear case is pretty simple, that I believe you're not going to need to pay Wix to build the websites. It's as simple as that. And I think the narrative is just not going to change. The number, but from a fundamental standpoint and a numbers standpoint, this company should be higher. Do me a favor, look at a chart.
Mm-hmm.
It's down 76% over 5 years. If it can't catch a bid with these numbers and it trades at 11 times this year's earnings with expected earnings growth while buying back a ridiculous amount of shares, there's a reason the narrative is what it is. And unfortunately, I just don't think that this is something that can get, I never play anything for a short squeeze. This thing is 20% short.
I think this is a David Justice. You guys remember Moneyball?
Oh God. I'm paying
you guys
you
remember
the player you are today, not the player you used to be on the Yankees.
Right. So I'm looking at this company and I'm looking at 1 point something billion in cash minus the long-term debt. So they've got more cash than the debt, which is always good to see because that means that they're not leveraged. They're still generating $500 million a year in free cash flow. Like, what am I missing here? I really need to know what I'm missing here. Other than the narrative is
you're not missing anything. This was a business that was in negative EPS growth, and they're buying back a ridiculous amount of shares to prop it up, which is not bad. It's actually expected to increase EPS by Tanner. The EPS growth for this year is expected to be negative 31%.
I mean,
that might be true. I don't know if they have any one-time expenses or something like this.
But next year, it's supposed to be increased by 46.56%. So
yeah, one of the big, not bear case. Well, you can call it a bear case, but it's not a bear case. But Base 44 is not profitable. This is their not recent acquisitions, June of last year. That is going to continue to bring margins down as it scales. So margins are going to continue to deplete, like quarter after quarter. It's going to keep going down. But if you look at their competitors, like one of the things that I find really interesting, like Lovable is one of their direct competitors versus Base 44. And Lovable has like a $6 billion valuation for having 300 million or 250 million in ARR. Base 44 alone has $150 million in ARR, and they're being priced alongside Wix for $2 billion. Like, it makes the valuation just doesn't line up.
I mean, their share compensation is fine. It's not even expensive. I mean, most of these SaaS names, you look at their share-based comp, it's insane. Their share-based comp is fine. The administrative costs could probably use a little bit of a haircut, but I don't see this as a bad business. I mean, they generated 600 million.
Chris, here's the other thing.
Okay.
Wix shares fell 30% after Q1 results because the non-GAAP EPS declined 56% year over year to 68 cents, with revenue increasing 14%.
But why though? Did they have like a one-time charge on something, or like what is the reason why they had this massive move down in EPS? I mean, I don't see the numbers like that justify this thing dying all of a sudden.
Yeah, I'm not saying it's dying. I'm just saying the narrative is not going to change for this. And I think this is just another PayPal. I was super bullish on PayPal. I still think PayPal is a value play.
I also
But
feel like I'm scarred by
I think
by
this is
PayPal a
another
little bit.
PayPal at the end of the
I
day.
mean, this is something that I'm not a fan of right here. Q1 of 2025, their cohorts were paying $86, and then since then it's like 52. So they went from that initial cohort. Look at this in 2022, that initial 2021 cohort. Wow. Okay. I mean, it means that whatever they're selling.
Wait, go back. Sorry. Look, did that not say cumulative cohort revenue?
Yes, you're right. It's cumulative cohort revenue. But from what though? That means that oh, you're right. You're right. Hold on.
Yeah, they're not going down. The average revenue is going up per user.
You're right. You are correct. That's why this chart actually makes a lot of sense.
Yeah.
Right here. Yeah, this right here. So $52.
Yeah, that's all they're showing you.
Yeah, so this one. No, I'm saying this was not as strong as the one over here. This blue line, which was, I'm guessing, 2020 and 2021 when we had like the pandemic, you know, where everyone was at home.
The red dot is higher than all the other ones.
No, isn't this line different?
No,
This
that's
red line.
That's the quarter before.
Wait, there's two red dots. Maybe one is dark, one is.
Yes, is it? But the 52 dot is this quarter. That's Q1. The other one, because it's a line,
okay.
is
2025.
yes.
Okay. Yeah. Okay. That's confusing.
Yeah, so it's
Actually,
showing
good.
you the year of growth there, which is also in line with what people are coming on this quarter at. Because base 44, the average monthly cost on base 44 is higher. But also, that's one of the things, like they talked about on one of their earnings calls that I was listening to, is they said people are coming on, signing up for base 44, and they're only doing like monthly subscriptions because they're just trying it. And then they pour in with tokens. They create these apps, they start making payments, and then they stay with us, but they're not, their website's built. They might fix things, they might add things, but they're not nearly token dumping as much as they were month one. And so the customers that come on initially have the worst margins. As they stay with base 44, the margins get better over time.
Yeah, once deployed, super agents run continuously in the background, responding to triggers, schedules, real time. I mean, this looks like a lot more sticky of a product than people are thinking. Like base 44 reaches 100 million ARR in early March.
Yeah, it's 150 now.
My recommendation to you, because you did the initial work on it, is to keep going. And even if it's not the most massive part of your portfolio, if you're looking at this, look at this from the lens of like a bear. And if you don't see something, put a couple of percentage points of your portfolio in it just to track it. Who cares? If it's 1 or 2%, that's what NVIDIA made in a day today. You know, if this thing if you think what this thing is going to do, this could be a 5Xer if they buy enough shares back and the narrative gets pushed away.
They announced they're buying back 40% of their outstanding shares over a 2-year plan. Like they are.
I mean, that sounds pretty good to me.
Dude, I know. It's a very interesting story.
This is not a bad story. I think. I mean, look, I know you're not a value guy, but in terms of like value, I think you actually hit one out of the park here, brother. I would say I'm going to do my own independent research on it just to double check all my numbers and stuff. But I mean, it's up almost 15% this week.
Yeah, I know. And I pitched this to Steve last Wednesday, and he was destroying me in the chat. And I was like, this is an interesting name. I'm telling you.
Yeah, no, I still don't like it.
Listen to your gut, man. A lot of times we have this thing where we want to listen to the next guy who seems smart, and I don't recommend anyone listen to me. I sometimes sound smarter than I am, but trust me, I've gotten things wrong plenty of times. But if they're buying back if they're buying back this many shares, you're talking about a structural move up, regardless of anything. If anything, this is a perfect target for private equity to buy it and milk it until you can't milk it anymore.
Agreed.
literally
Agreed.
in 3 years, you get all of your money back, and then it's just pure ROI. You don't even have to throw a single dime into this business anymore, and you're still getting a 25% return per year.
Yeah.
Just based on its cash flow. You're telling me you can buy a $2 billion business that generates $500 million in pure cash flow for $2 billion? Tell me a place where you can get that kind of ROI, because I'm willing to put money in it.
Well, you let me know if you buy. We can have another name overlap if you talk me into it.
I'm thinking about it right now. Shoot, this is actually a very interesting play here, man. I don't think it's got, like, even if it does go down, I don't think there's really much more it could go down. You're talking about a company who's got like 6 times forward EV to EBITDA, unless there's some kind of like one-time related expenses that they have coming or something goes horribly wrong with them. Just structurally over the next couple of years, if AI does even 15% disruption rather than 100% disruption, I think this doubles on you, which is not bad.
That's not bad.
I'm still trying to think, like, $2 billion for $500 million cash flowing business. Like, people will pay Chick-fil-A to be in their what do they call, triple net leases and get a 6% ROI, a cap rate of 6%.
People are saying you're going to now steal it from me from the draft.
I'm not going to steal it. If you want it, you take it. But this is actually a very interesting value play here. Just
Tanner,
saying,
do you
like,
have your plan for this year?
I honestly have not given it enough thought, unfortunately, but I will. I need to, because I'm in last place.
you got 2 weeks. Well, I guess 2.5 weeks.
Yeah. But guys, I got to go. I'm going to go have a sauna.
Whoa.
Later. Have a good one.
Whoa. Sauna at 11:12.
Yeah.
Your sleep score is going to be under 70 tomorrow.
I saw Mitten, Kris, and Steve, and then you sent me a link, and I was like, this is the dream team. I gotta join up, but usually I would not be on the camera this late.
You be
Listen,
out.
I know I push on you, Tanner, but that's because you're worth pushing against. All right. So just remember that. If you were a dumb person, I'd be the first one to just lay down and be like, yeah, let him talk and then call it a day. You actually have some of the best ideas in the market from what I've seen. And I do watch your streams, even though I don't participate in your chat sometimes. I do watch. So just letting you know, you actually have some really good ideas. And I am not too proud to admit that I steal ideas all the time. All the time.
Well,
that's the mark of it. Yeah.
This sounds like a backhanded compliment. Like, dude, just so you know, like you're not you're not.
No, I'm trying to give you. I'm trying to give you a confidence boost, because, like, the fact that you found something like this, Steve pushed against you, and you said, "Well, you know what? I'm not going to buy it because I've had bad." Nah, bro, believe in yourself. Believe in your thesis. Unless you find something.
I feel super confident in my picks. I just also feel extremely like. Look into CoreWeave and tell me how you feel about that name. Like, I love these types of names where I think people just, I don't know, maybe don't see the compounding interest as much as I do. And so I just really like the fast growth of some of these names. It's just easier for me to wrap my head around.
Yeah, I mean, to be honest, if you had brought this to me and said, look, this is a 15 forward EV to EBITDA, I'm thinking about buying it, I'd be the first one to tell you probably not a good idea. But you're talking about a company that's literally like someone just threw away, even though this is actually a good return.
Yeah, I think the forward PE on this company, like last week, whenever I was looking with Steve, was like 9 times.
Yeah, I mean, I would say for a company like this, I wouldn't even look at the PE. I just look at the forward. Cash is probably the best way to go about it.
Yeah.
Because, I mean, just look at this on a forward cash basis. Let's see, per share. And think about it. They're buying back 40% of the company. So in 2 years, you can actually project out, like, what if they buy back this much? What is this thing going to be worth? On a per share basis, they're generating cash, free cash flow per share.
Raven said Tanner is trying to talk Steve into buying CoreWeave last week too. And he called me and he said he bought it. And how's that treating you, Steve?
Which one?
CoreWeave.
I mean, I think I'm making money on it.
Yeah, you are.
What's
You're doing good, man. I live to make you money, okay?
Yeah, I mean, listen, you were right on Micron. I got in at 709. You were 100% correct. Looks like you're going to be right on CoreWeave. You are obviously correct on NVIDIA. And NVIDIA, I pushed back on you in the beginning.
Let's not forget about BM&R.
Oh, thank you for that, Steven. Thank you, Steven. Thank
What?
you. I just want to say I really appreciate all
You're
the
welcome.
guidance of BMR.
You're welcome.
Fucking Tom Lee got us all, man. The one time Contrarian Chris lays his hands down and joins you guys, I got raped. Damn you, Tom Lee. I got raped by Tom Lee, bro. I used to watch his videos every day. I used to be like, oh my God, another freaking fun strap video's dropping. Honey, turn off the lights. I got to watch this. Now I'm just like, yo, fuck this Tom Lee dude. Like he was on CNBC. I had to turn that shit off, man. That shit gave me PTSD.
We watched that freaking, what was it? The annual shareholder meet. We all should have sold that day.
The freaking when they were in Vegas?
The Penguins, God. Yeah, and the car showing up on the annual shareholder meeting. Like,
oh God.
oh man.
Tom Lee, you got us. You got us. You Kathy Woods us.
Yeah.
Whatever. But Tanner, dude, $10 free cash flow per share. I mean, it dipped right here. I wonder if this
I hope you're talking with your money. You let me know whenever you buy, and then
oh hell yeah, I'll let you know. I'm doing my research tonight. I got a project going on tonight then.
There
Chris,
we go.
do you have any of the hyperscalers? I'm not hyperscalers. NeoClouds.
I don't. The reason why I don't have any of the NeoClouds is because I look at them as like massive REITs, and I'm not exactly the biggest fan of REITs, but I don't know. Just I feel like I missed it, and every time I look, it just keeps going higher and higher, and I don't want to chase. And I learned my lesson because of Tom Lee. To be honest, I know all of you guys are in Nebias and CoreWeave. Congratulations! I'm more power to you. I will be happy to be the last guy on your guys' private jet if you deem me worthy of getting on your private jets. All right, but I'll ride in the back. I don't mind. But yeah. I'm not doing that shit anymore. Where I'm like, yeah, I'm gonna borrow Steve's conviction or Tanner's conviction. No, I'm gonna try to get my own.
I gotta tell you, I don't think Tanner's wrong on it. I actually
on what?
On CoreWeave.
I'll look into it. No, I won't. No, I won't. Stop. No, I already made up my mind. I'm not doing it. No.
This thing topped out at 187. It's at 124.
I don't care. I'm good. Stop.
You should look not just at their growth that they're putting up right now, but their backlog growth. Their backlog is growing like 284% year
I
over
don't
year.
care, bro. I don't care, right? BM&R was supposed to take me to the fucking retirement home, right? No, I'm good. I am good. I don't want to look, okay?
But
I don't want to look.
The difference is BM&R was never a business, you know? This is actually a company that sells products to the biggest organizations in the world.
All of you guys said BM&R was going to be the next big thing, and I believed you, okay? All I did was see green, and then what happened? I saw nothing but yellow.
I thought you said those were virgin mojitos.
They are virgin mojitos. I'm just, you don't understand, man. I'm so hyped up right now. Just
okay, guys, I'm out of here.
All right.
Later, Tanner.
Thanks for having me. This was a lot of fun.
Yep. Later, Tanner.
All right. Peace.
Take care, guys.
All right. We're going to call it here. It is 11:18 at night.
Don't you dare ever bring up CoreWeave in front of me ever again, or Nebius for that matter. Okay? Those trains, I miss those trains, and I don't care to try to catch up to them.
I just got on the CoreWeave train.
Okay, congratulations. I'm not getting on there with you. I'm not getting there on there with you.
I think I bought a 105.
I'm not doing it. I don't care. I'm staying out.
Dude.
If you guys get private jet money, I will be more than happy to bum a ride on your private jet. I don't want it. I'm good.
Just look at these forward.
Stop. I don't care. I really don't care. Stop. Don't show it to me. I don't care. I really don't care. I'm done. I gotta go, Steve. Bye.
All right.
I would rather buy Build-A-Bear than buy CoreWeave. Okay, I'm good. See you later. Bye.
Later, Chris. All right, everybody. Thank you for hanging out with us. Really appreciate it. We'll see everybody next week, and I will see everyone tomorrow morning. Have a great night.
Take care.